Hail of two banks continues.
Let's turn to Gerard Cassidy of RBC. Judge, you've been going through these numbers. What jumps out for you?
I think what jumps out, John, is what we were just talking about a minute ago, which is the credit side. As you guys have just identified, the provisions for loan losses are coming in much better than expected. Generally, it looks like, as you identified with Wells, the revenues came in better than expected. So really, and the stocks are showing it in pre-market trading by trading up, that so far, the very quick read of the numbers, they're generally better than expected.
Gerard, the fact that JP Morgan shares are lower really edifies the point you were making. They have a much higher bar to clear given their performance year to date and a much lower bar for all the other banks to clear. Is that basically the read-through that any kind of beat for the likes of Wells Fargo, yes, it can lead to a 3% pop. JP Morgan, basically, it's been baked in that they are always going to have an upside surprise.
Lisa, you said it well. You know, JP Morgan has had a great year relative to the other banks in performance. It's the risk-off trade. When we go around and talk to institutional investors around the country, as well as Canada and Europe, everybody is generally, not everyone's, a vast majority of investors are underweight banks, except they own JP Morgan. So it's an over-owned name. And as you just described, it's showing that way today because they've done so well, but the others, the bar is much lower.
Elisa's making trading bank stocks sound easy, Gerard. Gerard Cassidy of RBC Capital Markets on the latest. Got to turn back to that communication, that language being used by the JP Morgan chief executive, Jamie Dimon. Maybe the most dangerous time the world has seen in decades. Shonali, Ukraine-Israel may have far-reaching impacts on markets.
Absolutely. And if you're JP Morgan, where you're operating in most countries across the globe, you're certainly thinking about the risks that you can't control. Now, remember, let's talk about it from the trading perspective, from the volatility in currencies and commodities. These banks make money, and JP Morgan wants to be the intermediary for that. We've been talking about this, too, that wonky value at risk. This idea is these banks have to put up more capital here to intermediate markets. At what point does that start to become conflicted and this risk of markets seizing under the pressure of these geopolitical concerns? Right now, though, they are making money. Listen, one more thing about the consumer here. JP Morgan, average loans are up 17%. So it's not like that's better than they were last quarter. So they're still lending into what they think is a very terrifying, let's say it, environment, both for the U.S. and global economies.
Well framed. Seriously, JP Morgan right now, by the way, down by about 1% in the pre-market. Wells Fargo higher by 2.4%. Citi still to come. AMH, that language from the JP Morgan chief executive might be the most dangerous time the world has seen in decades.
Not the first time he's speaking about Israel. You know, they have about 200 people in their offices there in Tel Aviv, and he talked about that all his employees are safe. But it is a dangerous time. I mean, in the last week, have we even talked about Putin's invasion of Ukraine?
Nope.
And what's happening in Ukraine, and also the concerns about what's going on in the Taiwan Strait?
Hardly been discussed. More reaction on the bank stocks coming up with Ken Leon of CFRA. JP Morgan a little softer in the pre-market. Wells Fargo rallying. Citi results still to come from New York. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Unfortunately, even though the situation in the Middle East is very volatile, the market has gotten used to looking past events like these.
I think the market is just trying to find its equilibrium right now.
If I'm right that inflation gets down to 2%, then a 10-year Treasury at about 4.5% sounds about right.
I wouldn't be surprised if the 10-year does cross 5%.
You're going to see some form of yield curve control brought in to stabilize the bond market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro, together with Anne-Marie Hordern. What a mental 24 hours in this bond market. Yields down, then aggressively higher, down again this morning by about 8 basis points on a 10-year to 462. Under surveillance this morning, bank earnings in full swing. JP Morgan beating on revenue. Wells Fargo gaining as third quarter revenue beats estimates as well. Earnings from Citi expected in about an hour from now. Goldman, B of A, Morgan Stanley all next week. And Bramo in the last couple of minutes, a new outlook for JP Morgan.
And basically we're looking right now at the potential for some sort of gain here in terms of how much they saw full year net interest income of about $88.5 billion. That is above the previous of $87 billion. So this definitely is a beat, and you can see them claw back some of the losses from earlier.
Given the monster moves we had in this bond market, let's talk about the commentary coming from the C-suite at JP Morgan on this. Jamie Dimon says the following, Bramo: the risk that interest rates rise further from here. Still don't know the long-term effects of QT.
This is the truth, and they don't understand this, and it speaks to what Jamie Dimon was saying when he said, well, we could see 7% interest rates. So the question is, how are different banks dealing with it? Are they hedging? Are they changing the mix of their assets? Are they buying a few treasuries? Is this the reason why we might not be getting the demand at some of the treasury auctions? Because guess what? Banks aren't the big buyers if they don't have to be in the same kind of way and are looking for new types of reserves.
And the price-insensitive buyer, the central banks, have stepped back. I keep going to what Daleep Singh had to say over at PGIM. We've lost that predictable source of demand in this bond market that dominated things for the last decade. Is there any surprise we're seeing these soft auctions at the long end time and time again?
But this then speaks to the uncertainty of banks and the fact that maybe they might be that much more price sensitive. They might be saying, look, you need to compensate us big time, because not only do you need to offset us for the risk of volatility, you need to offset the risk of the treasuries that we currently have on our portfolio that might be totally underpricing the risk of inflation, as well as fiscal premium being baked in.
Fiscal premium, are they talking about that down in DC?
No, they're not. They're talking about trying to get a Speaker of the House. Nothing can really get done at the moment. Steve Scalise, everyone thought potentially can get to 217. He can't. It still remains very unclear who in the Republican Party can actually get to 217.
JP Morgan, their stock totally unchanged, waiting for the results from Citi. Shanali's going to join us in just a moment. The latest on our top story over the last week: Israel calling for an evacuation of the roughly 1 million civilians in Gaza City, indicating a ground invasion could be on the horizon. Secretary of State Antony Blinken meeting with the president of the Palestinian Authority in order to ease tensions in the region. Next, Blinken heading to Jordan and Qatar. And today, Defense Secretary Lloyd Austin is expected to meet with Israeli Prime Minister Benjamin Netanyahu. Who isn't Secretary Blinken meeting with at the moment,
Well, he's doing a regional tour. Bahrain, Saudi Arabia, the UAE, Egypt. Missing on this list, and you need to pay attention to, is Turkey.
Especially because Erdogan has come out very much in support of the Palestinians and against Israel in this particular situation.
And criticized the U.S. for sending in Gerald R. Ford and said that would cause, quote, massacres in what is going on in Gaza. There's a lot of tension right now between Ankara and Washington.
You mentioned this already in the last couple of moments. Let's talk about it. The search for the next Speaker of the House taking a step backwards, moving in the wrong direction. Majority Leader Steve Scalise...
My name. There is talk of potentially it just needs to be someone who is completely out of the leadership, who has been out of the leadership this year. The problem is they can only lose, whoever this individual is, if Democrats stay together, they can only lose 4 votes. At some point, you might see a moderate Republican come out and say, listen, I'll have a bipartisan ruling coalition with the Democrats. But we're not there yet.
All I can say is that things have gotten so dysfunctional that not only do we have members that are contesting the election and that are potentially going up against each other, we don't even have a name. We're talking about potentially somebody who hasn't even been named yet coming in that might not even be in leadership. There's also discussion about Patrick McHenry being given a 65 or 45 or 60-day temporary position as Speaker. He's saying, I don't want this. This is ridiculous. So we're dealing with a situation that is fraught and is opening the pathway to something like you're talking about.
But a Patrick McHenry could actually be very smart for the Republican Party. November 17th, we're potentially going to have another government shutdown. That is how Speaker McCarthy lost his job. Maybe they just throw it on McHenry. You're going to have to do a stopgap. You're going to have to keep the government open. Just let him deal with this, and then by next year, we can elect another Speaker.
I'm guessing that's another reason why he doesn't want this job at all. We'll talk about this a little bit later. Greg Valliere, later on this hour of AGF Investments. Let's talk about the banks. JP Morgan results out in the last 15 minutes or so. The stock not doing much. A new outlook for the big bank on Wall Street. Full year net income interest of about $89 billion. They had seen previously $87 billion. Net interest income, Shanali, better at JP Morgan.
Well, not only is it better, it's because you're seeing them really lend, and the consumer is taking on more loans, especially excluding credit card loans. You're seeing consumer loans start to rise on average at JP Morgan. We were talking about this. How much demand really is there for loans in this interest rate environment? How much propensity is there from the banks to lend to the U.S. consumer, given those concerns about the economy? Jamie Dimon, as you've been saying, strikes a very dire tone about the global geopolitical tensions that we're seeing, but the numbers are showing you something more rosy in terms of what they're able to do by servicing U.S. consumers.
Square this with their sort of dire calls that if they're overregulated, the profitability goes down the toilet. There is a question. JP Morgan did say that the quarter included $113 million of net reserve build, kind of speaking to that regulatory story that Anne-Marie has picked up on. How much is that bigger, less? Put that into perspective about what that actually does to a bottom line that looks pretty good.
I have to be honest with you, I'm dreading the conference call because you're not going to get a whole lot of answers here in terms of the direct financial impact that will happen over time with the rules that are coming forward, because the banks are still fighting these rules. They are taking to Washington and storming the Hill and saying, we don't need these. We are lending to the economy. Seriously, though, I mean, it's all you really hear about, because the uncertainty behind those new rules could be very damaging. They could wipe off a very significant amount from the bottom line, as well as restrict the capacity. Now, you're talking about the Treasury market. That is very relevant to these new rules, because what they're saying is intermediary capacity is further threatened by these new rules. And what you're seeing also is Jamie Dimon really clamp down on the we don't know what QT, quantitative tightening, looks like yet. So why constrain further?
Shanali, stay close. We'll talk more about this. Joining us now, pleased to say, is Ken Leon, Director of Equity Research at CFRA. Ken, you've gone through the numbers from JP Morgan, from Wells Fargo. What stands out for you, sir?
We got through the quarter, so year over year, we did see gains, but compared to the second quarter, both banks held their own. So I think operationally, this was a good quarter, both on the consumer and commercial lending, barring real estate, is still very good with double-digit growth for JP Morgan Chase. It really sets up the bigger story here. We talked about capital risk. We talked about rising rates. But the market is thinking if we have a soft landing in the second half of next year, financials tend to do better 9 months before, and JP Morgan is one of the top 3 of the weightings for the sector. So that, to me, is the cornerstone for the bank story. Then we have to go through what does rates do to the consumer, plus what eventually happens as it relates to, credit risk, which seems to be everything is under control, as we see with reserves and actually some reserve releases in home lending for JP Morgan.
Again, we're getting the results from the big banks, and this has been a pretty strong result. Fewer credit loan loss reserves put aside. But then PNC is cutting its headcount by about 4%, and we are seeing a more mixed picture, hitting a lower than expected revenue target. How much is this really painting the picture for you? That basically big banks are not the banking complex when it comes to the health of the U.S. consumer, the health of corporate America, and their reflection of that?
Well, I still think they're there. And then as you go from the global U.S. banks to the super regionals, you begin to see the really stronger weighting to lending and also net interest income, just because they're not diversified. And it does put added pressure on them. And I would think the first 5 questions on the regional bank calls are really going to be about regulation and higher capital risk for those banks with more than $100 billion of total assets. It's a new regime that's coming in for these banks as well. And as you get to the very small banks, then you begin to see some exposures to deposit risk or narrowing of spreads. This is, basic bank fundamentals. The other regime here, which is a conversation for another day, is private credit. And what we're seeing is, I want to see how many times on the large banks we hear the word, we want to go balance sheet light. We want to find partners to offload some of our credit where it might be too expensive to keep it for credit regulation.
So just quickly, does that mean that from your perspective, it makes sense to value banks like utilities, especially the big banks that are showing a great deal of safety and precaution?
Banks are directionally, unfortunately, moving to being more regulated and being more utility-like. And what keeps me up at night is when you look at the securities, you have to have, you can outrun that as having a soft landing of the U.S. economy.
Hey, Ken, stick with us. Ken Leon there of CFRA. We'll be breaking down Citi in about 20 minutes from now. JP Morgan, totally unchanged in the pre-market. Wells Fargo, a little bit higher here, Bramo. Not big moves, up by 1.8%. What you heard from Ken there is just why it's so difficult right now for bank stock bears to change their mind on these names.
Exactly. They can come out with better than expected performance, and it still isn't going to change the scenario that they cannot necessarily buy back their shares in the same kind of way or give dividend payments the way that their shares might imply, because they are increasingly regulated and are going to have increasingly conservative profiles that limit the upside gains traditional for a big bank.
Numbers from JP Morgan and Wells Fargo behind us. Citi still just ahead about 20 minutes from now. If you are just joining, welcome to the program. You probably want to know where the bond market is after the sell-off we saw yesterday. Yields are lower by, guess what? Double digits, 10 basis points lower on a 10-year to 460. If you're looking at the equity market on the S&P 500, negative here by 0.1%. The big moves, Lisa, they continue. It's why I keep framing the question. You want bond market stability. What do you really mean? Do you want yields lower, or do you just want smaller moves day to day?
How about both? How about yields lower and smaller moves day to day? This is a market that grew up under a regime that was both, that was incredibly low rates, that were incredibly stable, and that were controlled by the Fed, and this idea that we're going to get low inflation forever. There has been a regime shift. Nothing has broken yet. Some people might argue that on the peripheries, whether it's the regional banking crisis or whatever, things are breaking. And is that giving people confidence, or actually more fear that the volatility is going to perpetuate and become that much more extreme over the near term?
To your point, something did break this year. The bank stocks broke in response to what we saw, Shanali, in the Treasury market. Do these moves make it worse?
Yes. I mean, the thing about it is that you're seeing deposits starting to stabilize, so maybe we won't see the same sort of drastic pressures. There are different ideas out there in the market on whether we'll see more failures or not. The worst is probably over, according to most market participants, but that doesn't change the story about the pressures you're seeing. We're talking about loan growth. Yes, great. All well and fine. Expenses are also growing. The flip side of that is, you have JP Morgan and the headcount is up. And so they're hiring, they're willing to spend more on wages. And so, the relative stability is allowing them to invest. But investors don't have a story to latch on to yet until that story starts to turn around.
Stock just a little bit unchanged on JP Morgan. Just a little bit firmer by, let's call it 0.2% on the S&P 500. That's the bank stock story. Citi coming up in about 20 minutes' time. We'll talk about politics as well, abroad and at home, with Greg Valliere of AGF Investments on the search for a new Speaker of the House. The comedy in Washington, the dysfunction.
Is this comedy?
Continues. Not very funny, is it?
It's horrible.
At the end of the day. From New York City this morning, good morning.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pray for resolving this conflict as quickly as possible. The longer it goes, the more the risk of spillovers grow. And where we are as a world, we simply cannot afford more uncertainty, more hate.
That was the IMF Managing Director catching up with TK. Bloomberg's Tom Keene a little bit earlier on today. We'll catch up with TK ourselves in about 15 minutes' time. Then 30 minutes after that, we should get some numbers from Citi in the next hour too. Looking ahead to all of that, your equity market on the S&P 500, negative here by 0.1% on the S&P. Just had a message from a Bloomberg subscriber about the numbers we got from JP Morgan. Let's start with the fear first. Earnings season, alarm bells, consumers falling cash buffers, inflation, monetary policy risk, the consequences of war. We're leading with that. We're talking about it. Then ultimately, Bremo, the bank raised its year net interest income forecast, provision for credit losses, net charge-offs lower than expected. Which one do you want to focus on? Which piece of this?
Basically, if you're an investor, you focus on the fact that they're making money and they're making more than they expected to. If you're someone who's a policymaker who wants to hook into what the broader messages are, maybe you'll hook into the other. But for ARP reasons, I think that we've got to look at the numbers because the numbers speak for themselves. The uncertainty is clear. We all know about the uncertainty, or we know that there are a great deal of unknowns. The certainty is they're making bank, and I think that is what we could take away.
And Tom talks about this all the time. They're almost hiding how much money they are making
that's
by
true.
leading with these dreadful headlines.
It's true.
Elsewhere. Just see it every single quarter. Not just JP Morgan, but, across the street, time and time again. Let's turn to Greg Valliere, the Chief US Policy Strategist at AGF Investments. Greg joins us now. Greg, wonderful to catch up with you. We had this phrase that we borrowed from a famous comedian in the United States in the last hour. Aren't you embarrassed? Is Washington embarrassed by the dysfunction that's playing out currently, given what's happening in the world?
Well, we should be. This city should be embarrassed. It's a clown show. It's a circus. And the serious part of the story, John, is that there are three big things that have to get done. One is, of course, a budget, and I think that November 17th deadline will slip. Maybe they'll do another extension probably into next year. Number two, we really need more aid for Ukraine. They're starting to run low. And now a third story, of course, and that's aid to Israel, which is mandatory. The irony here is that a vast majority in both houses, in both parties, want to do all three, but they can't get it done.
Greg, who can get to 217 within the Republican caucus at this point?
You got me. I mean, I thought that Scalise would be likely. Jim Jordan isn't exactly Mr. Personality. I'm not sure he's going to get there. So I am beginning to think they go for someone less well known. There's a House member from Minnesota, someone from Oklahoma. They may go for a fresh face who's not as badly damaged as some of these others.
Are Democrats just as much to blame for this paralysis we're seeing in the House of Representatives?
Well, a little. I mean, everybody's blamed. A pox on both of their houses. But I would say that Hakeem Jeffries and others are valid in saying, why should we bail them out? They want to impeach the president. They've done a lot of things in the last year that have been inexcusable, according to the Democrats. So I think they're not in any great rush to help them out.
Greg, for a long time, this stuff hasn't mattered. Does it matter now?
It does. I mean, we need these loan packages. We need to get a budget. People worry about government benefits, their salaries, things like that. And there's one other factor, John, that I think could come into the narrative once again, and that's the credit rating agencies like Fitch and S&P. I wouldn't be surprised if we see another credit rating downgrade on the U.S., and that's not a good story.
Every investor who's come on has said that there is absolutely no incentive to grapple with the real issues that are going to cause serious problems for the U.S. economy and for the U.S. deficit, Medicare, Medicaid, defense spending, and some of the other entitlements, Social Security. How much do you see a greater willingness later this year or next year if interest payments start to significantly be the main expense of this country?
Well, you're speaking logically, and logic doesn't always apply, Lisa. And I don't know that will make a big difference. You know, the problem is that, you know, I go around the country, I talk to investors and ordinary people, and they all say, we have to reduce the deficit. And then I give them a list of options, and to everyone they say, no, these are not doable. These are not politically sellable to the voters. So we could have a national consensus that we need to do something on net borrowing costs, but there will not be a consensus on these specific prescriptions.
Nobody wants to take the poison to come along with the medicine. There's a question here, though, Greg, especially as we face off with a number of conflicts around the world where we have the U.S. calling for more money and more resources to be deployed, whether it's Israel, whether it's Ukraine, whether that's going to mean more borrowing and an even bigger deficit. Do you see that in the pipeline, that basically not only is there no incentive to cut, but there is incentive to spend more, and the result will simply be felt maybe at some of these bond auctions we've been talking about?
Two enormous wild cards that I think will determine the answer to your question. The first is, could we see movement by Hezbollah in the north? That would be horrible to open up a second front. And secondly, Iran. I think once Hamas is dealt with, and they will be dealt with, I think the Iranians will be targeted for at least some kind of increased sanctions because of their support for both Hamas and Hezbollah. So those factors, to me, would make me think that a lot more spending on defense is going to have to occur.
We saw yesterday the administration come out, along with Qatari officials, and say that Iran at this moment cannot access that $6 billion that was unfrozen from the South Korean banks for the prisoner swap. Is this administration going to come under increased criticism for their strategy in Iran specifically?
Well, the Iranians are furious. The New York Times broke the story early this morning, and I think this is going to be a big controversy, but they're not going to get that money. I think that is inconceivable, considering all the political problems Joe Biden has. The last thing he needs is to give the Iranians $6 billion.
Just a week and a half ago, Jake Sullivan, Greg, said the Middle East was the quietest it's been in decades. Today, we have Jamie Dimon, a CEO of JP Morgan, coming out and saying the world is the most dangerous we've seen in decades. Is this administration going to face the consequences of what is going on in the foreign policy sphere come November of next year?
They may. I mean, there are so many things, my lord. The fact that we're averaging 8,000 illegal immigrants a day coming into the U.S. We have big urban crime. Average voters don't think inflation has been subdued. So, yeah, I mean, this could be still another huge albatross for Joe Biden. He's in a difficult spot. I think that Blinken is good. I think Sullivan's good. I think they may calm this thing down by the end of the year. But I think we got several really rocky weeks ahead.
Greg, it doesn't look great. It really doesn't. Greg Valier of AGF Investments. Greg, thank you, sir. We're looking ahead to some key events. We need to talk about the privilege of acting recklessly with a budget deficit. For a long, long time, this government, this country has had that unique privilege given they issue the Treasury bond. And now looking at the moves we've seen over the last few weeks, I'm not saying it's completely lost, Bramo. I'm just saying you can see clearly there's a deterioration in appetite for treasuries in this market, particularly at the long end.
And when you talk about the privilege of acting recklessly, when suddenly interest payments, interest expense needs to be considered as a massive line item in the U.S. budget, suddenly you have to care a little bit more. And if you don't, then potentially you could get into the spiral where yields go higher and then interest expense only increases that much more.
The Congressional Budget Office, you need to see this chart. 28 years, it'll be the top issue. Interest payments will be the top line item the U.S. is paying for. And it's both parties to blame. You know, Republicans love to bash Democrats. They love to spend. Republicans love to spend, too. They also love tax cuts. Remember, it was the Trump administration that added nearly $8 trillion, which Nikki Haley, by the way, loves to bring up, to the deficit.
Everyone's super responsible until they get into the White House, get power, get majorities, and then all of a sudden it goes away.
I will say that it is everyone's responsibility, and I'm just going to be at a soapbox in for 1 second. I know you're probably rolling your eyes internally. But
Lisa, that's the show.
But nobody wants you rolling your eyes internally. But nobody wants to take the pain. Nobody wants to see their payments lowered. I understand this. I am a human being. Nobody wants to see the resources that you're used to getting pulled back. So then if you don't have a population that's going to vote for that, where is the incentive going to come from an individual leader?
The Treasury market will have to force the issue.
Exactly.
And that's not going to be pretty either. From New York City this morning, equities down 0.1% on the S&P 500. Yields in 8 or 9 basis points, 460 on a 10-year. The commodity market, crude picking up by 3.7%, $85, let's call it $86 a barrel.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
Equities on the S&P 500 pulling back just a touch. On the S&P, we're down by 0.01%, recovering very slowly this morning, off the lows and now unchanged. On the Nasdaq, we're negative by 0.3%. It has been quite a week in the bond market. Yields all over the place. Yesterday, double-digit moves higher on a 30-year yield, higher at one point by almost 20 basis points. Two-part story. One part was the CPI report, small upside surprise, got yields moving, got things going, then bang, 30-year issue, auction, came later on in the afternoon, and Lisa, it did not go well.
I just want to say, every time I used to bring up auctions in the look ahead to the day ahead, Tom would roll his eyes and he would say, who cares about auctions? Is this really going to matter? And I could just say, every day this week, the auctions have disappointed, have tailed. That's the jargon that people talk about, which is incredibly rare. And it moved the entire market. This was actually the trigger for yields to go much higher, much more than CPI and PPI. And so when people lump them together, I'm sorry. I have to say, really, because if you looked at the action after what we got, not so much.
I was always happy doing issuance, just so you know.
You just put that on the record?
Used to have a show, which Shonali will be anchoring later, Bloomberg Real Yield, which has an auction blog.
Yeah.
I agree, it's very, very important.
And right now, more so than ever, because it's testing demand. And guess what it's telling us? People don't want to buy right now.
They don't want to buy. Is that buying going to come back if yields go back to 5%, 5.1%, 5.2, 5.50? Jamie Dimon 6, 7,
8.
Who knows?
I mean, this is sort of the question, right? And is it going to go up in a straight line? And if not, and you've been asking a really important question, is it the level that's more important, or is it the way that it is moving, given the fact that Michael Schell was talking about yield curve control to control potential dysfunction in markets?
When equity market bulls say stability, what they mean is lower yields. I think people in the treasury market mean smaller moves. That would be my distinction.
I think that that's true. However, you're seeing so many more analysts coming out and saying, as long as you don't breach 5%, we're good. We can make it. We can make it happen.
Are we good right now? 462 on a 10-year. Let's turn to foreign exchange. Dollar stronger against everything in G10 yesterday off the back of that big move. Yields higher this morning. The euro just slightly negative, 105.22. We're negative by 0.06% on the day, Lisa. Had a look at 104 in the last couple of weeks, a look at 106, we're back to 105.
It seems to be where we're kind of sticking at the moment. We are watching the potential analyst calls. Citi earnings due out in about a half an hour. We did get JP Morgan and Wells Fargo, both beating expectations, increasing net interest income expectations. I am interested in the calls. 8:30 a.m. we get JP Morgan, 10 a.m. Citigroup, and 11 a.m. we do, 10 a.m. is Wells Fargo, and 11 a.m. is Citigroup. 10 a.m. This might move the market, maybe not. Facebook Live, another one with UAW President Sean Fain. What more can he say after a serious escalation that we saw yesterday, with the potential for Ford just to say, we're done negotiating? So what more can he announce?
What's on the table? 23%?
23%.
And what are they after now? 30-something?
It's a good question. Is it about the 30%, or is it about some of the guarantees about employment? They've been asking for 30%, but they've also been asking for a whole host of other things.
Ford has already said we're at our limit. And this was a huge wild card to play going after this truck factory.
So they're at their limit for the total package, right? and they're basically saying to UAW, we can have a conversation about how to move things, but these are the parameters. This is the total package.
So now, are there going to be further strikes announced, further walkouts, or is this the end of the road? And at 10 a.m., we do get that University of Michigan sentiment survey, which, John, is not going to be called on, has not been called on, will not be called on. And yet, this is what people are going to be looking at for not only just sentiment, but the look ahead for inflation expectations, and you can mock it, et cetera. Yet this has moved the market too, because we are so in the dark with what potentially is shaking things up right now.
We can talk to a man who has taken that call over the years many, many times. Tom Keene at the IMF meetings, the annual meetings in Marrakesh, Morocco. TK, wonderful to catch up with you, sir. I know you have a brilliant panel coming up a little bit later on this morning. We'll be taking some of that on Bloomberg TV and radio. TK, what have you got to look forward to?
All we're going to look forward to here is a debate about economic growth. But I'll be very honest, John, as we've seen over the years at Davos, at IMF, and other meetings, when the events change, these meetings change. And there's a tangible somberness here with everyone glued, as we are at Bloomberg, to what's going on in the Eastern Mediterranean. It's absolutely front and center, and the managing director this morning was quite emotional about it after a long 24 hours.
Tom, there's been a big question about just how unilateral, just how much the IMF brings the world together versus really trying to grapple with a splintering in the world order. How much unity do you feel among the people that you're talking to in terms of resolve, in terms of goals?
Lisa, this is a really, really important question in that you don't get here Davos speak. It's sharply different from the meetings of the World Economic Forum. And the managing director reaffirmed today their economic mandate, which is what they do. They don't try to traipse upon what the World Bank does. I would say, John, to your point in the bond market, and it'll be no surprise to you, I was having a beverage of my choice last evening at La Momunia Hotel doing my Jimmy Stewart imitation. And John, I saw Japanese yen move with that bond market. John, that's the great unspoken here, is the bond market, everyone's watching about it, nobody's talking about it.
I love that you're in the bar pretending to work, TK. Never change.
He's not going to respond to that.
We'll see. I mean, there's still time to go here as we stagger back to New York. But, you know, I must admit, John, it's just great to see you and Lisa and the other person doing a tryout in my chair. I just think I can't get home fast enough.
Oh, Tom, we miss you. Tom in the desert.
Tom Keene at the IMF meetings in Marrakesh, Morocco. TK, your seat will be here when you get back. Looking forward to catching up as always, and looking forward to this panel, which includes Gita Gopinath of the IMF and Christine Lagarde of the ECB. Timely conversation with Lagarde here, Bramo, coming up later.
Especially given the fact that you have seen a weaker euro and the potential for natural gas prices to really go up, not to mention the reliance on Qatar for some of their natural gas at this point.
9 Eastern time, a few hours away for that conversation with Tom Keene in the desert. TK in the desert. There's one for you. Yeah. Mark Lushini joins us now, Chief Investment Strategist at Janney Montgomery Scott. Mark, wonderful to catch up with you, sir. Let's just talk about this monster move in the bond market yesterday. The 30-year, with a move at one point of more than 20 basis points. Just absolutely ridiculous stuff. Mark, what do you make of these moves we've seen in the Treasury market?
Well, good morning. It's certainly volatile and breeding even more volatility by the way the uncertainty in terms of the directionality of these moves in the market. I mean, obviously, we've had a bit of a retracement in longer-term bonds here since the last couple of weeks after having blown out about 50 basis points since the FOMC meeting on the 10-year Treasury yield. And now it's coming back in a little bit, obviously whipsawing investors who were worried we were going to test a 5-handle on the 10-year and even higher in the 30-year, and conversely has come back in just as hurriedly as it went back out. So, I mean, obviously it is a function of a number of factors, the confluence of which probably include the lack of buying interest and not knowing where these yields are ultimately going to settle. Issuance continues to play a role, and there is a lot of judgment being applied, subjective judgment, on how much of the effect of this is occurring because of the term premium and the uncertainty around not only inflation, but to what degree growth and perhaps an improvement in productivity on a go-forward basis might keep yields more elevated historically than what we've seen over the last 10 or 15 years. And a consequence of that, of course, is leading to these kind of movements that you've talked about, which is obviously obviously keeping investors on their heels.
And earlier this year, we did see this percolate out into a regional banking crisis. Certainly that has remained, at least in the share prices. And yet what we've seen this morning from JP Morgan and from Wells Fargo are upgrades to their net interest income, fewer charge-offs than expected, a pretty robust report at a time when the volatility is creating more activity, at least when it comes to trading revenues in certain segments. Mark, are banks looking better because of the higher yields at this point or worse?
Well, certainly the money centers, at least so far from, as you mentioned, what we've seen from JP Morgan and even Wells Fargo, which is a little bit different in terms of its overall portfolio composition. But the money centers are in a better position to weather this inclement volatility in the fixed income market. And certainly JP Morgan benefited from the acquisition of First Republic's assets and the deposits associated with it. So it's obviously very encouraging to see the results early on in terms of how that's positively impacted their net interest margins. And I'm going to be curious, as you had mentioned, at 10 o'clock in terms of what management is talking about with regard to consumer. There was some creep in delinquencies we've seen in auto loans, particularly subprime, credit cards. We want to see to what degree that continues to be a pattern, or is it, again, something that is occurring so glacially that it's not going to worry us and others with regard to the state of the consumer. But, you know, it's more the small and mid-sized banks that will report here in the coming weeks that'll be important, because obviously with yields where they are at or even above where they were back in March when we had the initial bank turmoil with SVB and others failing, that continues to be a problem for the balance sheets of these small and mid-sized banking enterprises. So obviously they tapped the Fed's window back then, and to what degree, again, they're underwater, and it continues to influence their profitability, their net interest margins, because they've had to raise interest rates to retain deposits, is going to be a tell on whether we see any kind of near-term recovery, particularly once again, the banks outside of the major money centers.
How much, Mark, are you looking at any commentary on the consumer to really influence whether you're going to buy consumer discretionary or where we are in the cycle?
Very much so. We like to look at what the management, the CFOs, the CEOs of these banks are talking about. I mean, after all, these money centers are in every facet of the economy. They're the bloodline to the economy in terms of not just credit extension, but obviously what they can see through by way of the behavior in savings deposits, to what degree this abundance of excess savings is being drawn down to help to support spending, obviously, which propels economic activity here in the United States, to what degree they're seeing some hesitation on the part of borrowing, to what degree tightening lending standards, which we know have already been underway now for almost a year, continue to influence their consumers' ability to go and borrow for durable goods such as automobiles, obviously housing's in the doldrums, particularly as it relates to existing home sales, and last but not least, obviously delinquency rates, and to what degree they're having to provision for.
Hey, Mark, wonderful to get your perspective, sir. Thanks for joining us. Mark Lashini there of Janney Montgomery Scott. Let's talk about that range on a 30-year yesterday. Think about this. More than 20 basis points. At the low, 466.70. At the high, 488.37. Bramo, you and I have said the same thing time again over the last year. At times, it's like the 30-year has become a penny stock in the Treasury market. It's been absolutely remarkable to see.
We haven't seen companies really have to bank the paper losses, though, and this remains one of the key questions. When you actually have to bank losses because the moves stick for long enough, then what happens? Do we actually have to start to understand the ramifications of, to Tom's longstanding point, the price move, not just the yield move?
The TK looked happy over in Marrakesh, didn't he? Just comfortable.
Yeah,
been to the bar talking about dollar yen.
Think
Can picture that.
There on a camel.
What, in the desert?
In the desert.
Vitamin D, getting some sun.
Getting some sun. Yeah. This is for health reasons.
Yeah, oh my goodness. Sure. You think he's going to be outside?
You think Tom looks after himself on tour? I don't think so. I don't think so. If you just joined us, welcome to the program on the S&P 500 right now, totally unchanged on the S&P. We're negative by something like 0.03%. Yields are lower by something like 8 basis points on a 10-year, 461.65. We've got to move lower across the curve, the 2-year out to the 30-year. The 10-year's lower by 8 basis points. The 30-year is as well. We could talk about the price losses, Lisa. What are we talking about? 50 cents on the dollar at the long end for some of these bonds that were issued 3 years ago at the long end?
And if you just hold it and you do use the Fed's facility, which is what a lot of banks are doing, you can park it there and just get the face value back, and you don't have to record them in the same kind of way, so offset some of that risk. However, if you have investment firms, and this is something that we were talking about with Priya Misra, who are actually recording those kinds of paper losses, all of a sudden investors see their safe assets, their assets that are the ballast to their portfolios, providing the biggest losses they've seen ever. What happens if people start withdrawing money?
They're not so safe anymore, are they?
But what happens if you get outflows?
I'm with you. Then you've got big problems.
You got big problems.
You might see selling elsewhere as well. Shanali, lucky to have you with us this morning. Those unrealised losses, how insulated are these banks from them, given the policy moves we saw several months ago?
Pretty insulated, but if you see what's happening here, a lot of this move is happening in the private bank. It's the wealthier individuals that are also borrowing more, and they're more insulated to the economy than others. Other parts of the bank tell different stories.
Shanali, Citigroup, about 17 minutes away. You're going to stick with us to break down those numbers in just a moment. Coming up next, Congressman Mike Lawler, the Republican from New York, is going to be joining us very shortly. From New York City this morning, good morning to you. Equities going absolutely nowhere. Bond markets all over the place. Nothing new about that. We're down 8 basis points on a 10-year, 462.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I just shared with my colleagues that I'm withdrawing my name as a candidate for the Speaker designee. And I was very clear. We have to have everybody put their agendas on the side and focus on what this country needs. This country is counting on us to come back together. This House of Representatives needs a speaker, and we need to open up the House again.
And we don't have one, and we're still searching. That was Congressman Steve Scalise, the House Majority Leader. Joining us now, I'm pleased to say, is Congressman Mike Lawler, Republican from New York. Congressman, great to have you with us on the program, sir. I'm sure this is immensely frustrating for you. A time for America to project power, and at the moment, Washington, D.C. seems to be projecting dysfunction. How frustrated are you, sir?
Pretty frustrated, but you know, right behind the camera lens is the Capitol. And I was just looking at it before the commercial break, and the sun is shining down on it, and we've been through tough times in this country, and you know, we will get through it. We will be meeting this morning to reconvene and begin the process anew to elect a speaker. We have to come together as a conference, 217, to elect a Republican speaker in a Republican majority. The American people elected us to serve as a check and balance on the Biden administration, from spending to the border to international policy. There's a lot of work to do. And obviously, one of the first orders of business is to support our closest ally in the Middle East, the state of Israel, to ensure that they have the resources, financially, militarily, to do what they need to do to defeat Hamas.
What can you do, Congressman, in the next 24 hours to make sure that happens? There's a big issue right now for your party. Not only should this country be projecting power and solidarity with Israel, your party also needs to demonstrate to this country that you can govern. Why is your party failing to do that?
Well, look, what happened last week with the removal of Speaker Kevin McCarthy never should have happened. 8 Republicans teamed up with 208 Democrats, and I think people need to remember that. Both parties threw us into chaos here for no reason. And it was totally unnecessary, unwarranted, and unjustified. And so now we're forced to pick a new speaker. This is not like just electing a class president here. You actually need somebody who can do the job and do it well. There's a lot that is entailed in it. And, you know, I think we're going to get back in the room today, hash it out even further, and hopefully elect a speaker. Ultimately, again, when we get back to the work of the American people, there is a lot of critical work to be done, from the appropriations process to securing our border to increasing aid to Israel. We also have to deal with aid to Ukraine. These are critical issues, and I'm focused on that work, especially as a member of the Foreign Affairs Committee and the Financial Services Committee.
It's not just about who can do the job of speaker. It's about who can get 217 votes. A lot of your colleagues say they don't see anyone that can actually get to 217. Do you know an individual that can get to that number?
Look, we're going to come back in the room. We'll see who puts their name forward. I believe our strongest speaker is Kevin McCarthy. I said it this week. I said it last week. I said it the week before. I said it in January 15 times. We're going to have to hash it out. And obviously, there's some anger, some frustration, some hardened feelings in the room. But, you know, if we need to bring a Festivus poll in and let everybody air their grievances, so be it. But we have to get back to work.
Your district voted for President Joe Biden. Is it time for members like you to reach across the aisle and find a centrist speaker with the Democrats?
Well, respectfully, again, the Democrats helped create this mess. Everybody should remember that. 208 Democrats voted to remove the speaker. And the American people elected a House Republican majority to govern. So any deal with the Democrats would be to elect a Republican speaker. We need to exhaust all options within the conference. But ultimately, as a nation, as a country, we need to get back to work. And frankly, in my conversations with many of my Democratic colleagues, they regret their vote to remove Kevin McCarthy because they see the chaos that they've helped create.
But then, Congressman, to build on Anne-Marie's point, are you getting close, especially with your Democratic colleagues, to move towards some sort of centrist candidate to put up and then to be able to elect any bipartisan measure?
Look, right now we are meeting again today. I think we owe it to the conference to continue the discussion, to see any other candidates that put their name forward, take a vote, see where it lands, and then take it from there. Obviously, we want to get back to work as expeditiously as possible and get back to governing. That is why we're here. That is the focus. The American people are not interested in inter-party squabbles. They're not interested in, you know, the parlor game that often goes on in this place. There's real work that needs to get done, and that has been and will continue to be my focus.
A lot of people talk about the former President Trump as being the front runner and, frankly, the leader of the Republican Party. Who do you think is the leader of the Republican Party at a time when it desperately seems to need a leader?
Look, Kevin McCarthy was doing a phenomenal job as the highest-ranking Republican official in Washington. And I think it was the single stupidest political act that I've ever seen to remove Kevin McCarthy as Speaker. It undermined the majority. It torpedoed the work that we were doing. And, you know, I said earlier this week that he is our best player on the field and should have been should have remained as Speaker, and ideally would come back. But obviously, right now we need to elect a Speaker. That's the focus for me in Washington.
Congressman, this week you called on the Biden administration to start charter flights out of Israel. The State Department announced those flights yesterday. You have hundreds of constituents stuck in Israel. What are you hearing from them on the ground?
Well, there's a lot of frustration, a lot of angst, a lot of concern. People want to come home. Many of my constituents were in Israel for the holidays and when the war broke out, and so obviously they want to get back to the United States. I've been in touch with the White House multiple times, the State Department multiple times, to try and expedite this process to get these folks home. I had called for chartered aircraft as well as military aircrafts to try and expedite this process. We have nearly 600,000 American citizens in Israel, many of them dual citizens, but it's 600,000 Americans. And so, obviously, anytime you're in a war zone, you want to protect the American people that are there. Obviously, over 20 American lives lost. We still have people missing, potentially hostages. We need to do everything we can to bring our Americans home.
Congressman, a lot of your constituents in the Jewish community, I'm sure, here at home are on edge. Hamas, which, as you know, designated a terrorist group by the United States, also by the EU and the UK, calling for a day of rage today across the Muslim world and mass protests against Israel. Congressman, are you worried about the safety of your constituents, and what are you doing to make sure they have the security they need?
Well, I'm always concerned. I have one of the largest Jewish communities in the country, in the 17th Congressional District of New York. Unfortunately, threats of violence against the Jewish people are not new. And so law enforcement in my communities across my district have always done a phenomenal job working with leaders in the Jewish community, working with municipal officials to really ramp up police presence at synagogues or Jewish institutions to ensure that we don't have acts of violence. Just a few years ago, we had an attack in my district in Muncie during Hanukkah, killing an individual, and we want to avoid any such incidents across this country, but certainly in areas like mine, where you have large Jewish populations. So law enforcement always does a great job. I know they will step up.
Congressman, thanks for being with us today. Hopefully we can catch up again soon, sir. Congressman Mike Lauder there, Republican, on the latest dysfunction in Washington. Coming up very shortly, Ken Leon of CFRA, City earnings just around the corner.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Bloomberg has enhanced search on the terminal.
to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd. Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
At the end of the day, financial stability is the unspoken mandate of the Federal Reserve.
There's still plenty of weights on the economy here, and certainly when I look at inflation, I still think it's coming down.
That last mile to get us back down to 2% on a sustained basis, that's tough, and that's why the Fed is probably going to remain restrictive.
The question really for the markets is how long they keep rates high for longer.
I think this market is underestimating, or your typical bond investor is underestimating the strength of the consumer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow, together with Anne-Marie Hordern. Let's get to the price action right now on the S&P 500, totally unchanged. Bank earnings all morning from JP Morgan, from Wells Fargo, and right now from Citi. Fixed sales and trading revenue, $3.56 billion. The estimate, $3.25. You want equity trading and sales revenue, $918 million. The estimate, $964. And investment banking revenue, $844 million. The estimate, $662.8 million. The stock is higher by 2.3%. Shonali Basak alongside us with this morning to break down some of these numbers. Tons of numbers there, Shonali. What's the story?
A few things. You have credit losses coming in line with expectations. So very clean read across the three biggest banks in America in terms of that big worry of credit, consumer credit turning sour. It's just turning sour enough to keep lending at a greater scale to the economy. And now for Jane Fraser, this moment is a pretty big deal. She just got through announcing the biggest restructuring of her senior staff in 20 years. And you're watching her really win here on trading, investment banking. These are areas of Citigroup that have faced dramatic changes in personnel. Remember, the investment bank is now being run by an interim head. And so for her to beat on that regard in investment banking in a weak market is showing you that her changes are starting to take some steam, even as she's just thick in the middle of it.
And we will get some themes as some of these come out. JP Morgan and Citigroup both beating on FIC and missing when it comes to equity revenues. People will wonder what that means in terms of gaming out the volatility that we have seen there. Citigroup's expenses, operating expense, came in lighter than expected, which speaks to the reorganization. What are we expecting to hear later on in the investor call about how she plans to rearrange exactly how the bank is orchestrated and where they want to be a little more aggressive and where they want to be a little less?
Listen, the process Citigroup is going now now. The process is going such that they're going through every manager around the world and saying, do we need these jobs? And so that is a very, very painful exercise, and she herself has acknowledged that it's painful. But from the investor perspective, how painful could it be in terms of potential severance costs and other costs tied to this reorganization that Citigroup might face in the future? These are the questions for Citigroup, in addition to JP Morgan and others, with the higher regulation. What costs are tied to that? What can investors expect out of Citigroup in this kind of second phase of Jane Fraser's restructuring? Because the first phase is showing that she is delivering, and she's delivering faster than she told you she would.
We did hear from JP Morgan that they are reserving more than $100 million for some of the additional reserves with respect to potential regulations. Citigroup is saying that they plan modest buybacks in the fourth quarter. Can we get a sense of who's most behind when it comes to regulatory capital and who can afford to go out there and do some capital returns?
Well, certainly this is a very positive story for Citigroup to be saying such a thing in terms of capital return. I think what's weighing on the banks is that longer term story in terms of what it's going to cost them once we start to see these rules start to take pace in 2025 and forward. Another thing here, you mentioned expenses coming in better than expected. Interestingly here, you've seen a lot of job cuts on Wall Street. It has felt very painful throughout the year, multiple rounds. The question is, if this environment remains muted, which it is, it's muted, not every business line is rebounding. This is sub $100 billion, $1 billion in investment banking fees we're talking about. This is peanuts in the scheme of things. Can they keep people on staff? Will that start to get more painful in this muted environment? We have escaped the worst for this quarter. That's what the banks are telling you. But when do things get meaningfully better?
What are modest buybacks? What does that mean?
It says they can give you some money back, but don't expect a windfall if you're an investor.
Okay, there we go. Thank you for translating. Appreciate it. Citi up by about 1.4%. Back with us, Ken Leon of CFRA. Ken, you've gone through Citi. What do you make of it?
This was a good quarter. It shows that there's a progression of the restructuring, and yet some of their core franchises, such as consumer and treasury services, are doing quite well. So I think on an operational basis, we would give them an A. We also, for being courageous, Jane Fraser is moving ahead, as discussed, in terms of removing layers of management to reduce expense. And this is critical to get efficiency for this bank and to improve returns on capital. Lastly, let's not forget there's 9,000 employees at Citigroup that are working on a U.S. consent decree to improve their processing and regulatory regime for compliance. This is important. It sometimes gets lost in the weeds, but for many years, Citi did not operationally have the best platform for surveillance. I think they're getting there. Looking ahead for the investor, you're always tempted with any stock in the large banks trading at half its net tangible book value when the others are well above par. And I think we need to see just a little bit more traction with what Jane Fraser does, not only with costs, but you need a successful IPO on Banamex in Mexico. As you recall, they couldn't sell it, so now they're going IPO in 2025. So things look promising, but they're still not, hitting on all cylinders.
Well, Ken, that's the problem. That's the question. Do they have a problem with expenses or with strategy?
I think the strategy is in place, and it does take time now to get the right people in place. That would be the management teams below the C-suite or the first layer so that they can execute on the strategy. We also are talking, again, this could be a conversation in 2 quarters of a very highly efficient global bank as they paired off all of their non-U.S. consumer banks, except for a few areas. So I think overall, there's still a lot of more work to do. And that means that what we've learned with the Wells Fargo turnaround is that they don't happen over 6 months. They take 3 to 5 years.
Ken, we saw JP Morgan just notch a record quarter of net interest income, $22.9 billion. They now see total full year net interest income of $88.5 billion. Citigroup also raised their expectation for their full year net interest income to $47.5 billion from $46 billion. Is the takeaway from some of these results that higher yields are now becoming a good thing for banks, a tailwind rather than a headwind?
So one scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth, particularly if there's loan growth. But one of the worries we have is that still 25 to 30% of total deposits are still non-interest bearing. That can certainly shift and go to higher deposit costs. This is absolutely true in asset and wealth management for JP Morgan Chase, not so much a problem in the corporate areas where they have other reasons for keeping non-interest deposits in those areas.
But Ken, we're not seeing it yet. And this is something that a lot of people have pointed to, that these deposits have been sticky, that it is such a pain in the butt to actually move all of your money from one place to another and rebank with an entirely new institution, that people just are not doing it. What makes you think that people are going to start doing it, especially if they do start investing in other assets, and they haven't so far?
Well, we actually did see that again in asset and wealth management, down 8% on deposits. But in the other areas, I think you're right. It's a little bit stickier. There's lots of reasons for small business or sometimes for consumers, to keep those large balances in checking accounts.
Ken, I want to finish with the bond market if we can. Something Lisa and I have been talking about now for weeks. Do these banks need lower yields or higher yields? A long, long time ago, we'd catch up with people who would tell us forever that what they needed was yields higher, rates up, because they can become more profitable off the back of it. Ken, has that changed this year?
It really hasn't changed, but it's, for net interest income, which is very different than the bond conversation, it's loan volume growth. I think for the bond market, it's really what happens in investment grade that's so critical. Again, I want to see how many of these banks talk about getting to be balance sheet light, which means possibly partnering with private credit partners, given that they may have some portfolios that just don't make any more sense with higher rates.
So that means selling off loans, Ken?
Yes, it does.
Interesting. Ken Leon of CFRA, thank you, sir, for being with us this morning to break down JP Morgan, Citi, Wells Fargo. Shanali, what do you make of that final comment there from Ken?
Listen, it's the truth. The bankruptcies are rising. Torsten Slok is talking about it this morning as well. You have, at some point, the banks. You have Citigroup, $400 million in debt underwriting here. That is way better than expected. So they are making money by lending to corporations, but the big banks want to lean towards those safer corporations. And private credit can go clip their 14% yields here on those riskier companies if they want to.
But this raises a question of what these banks' roles are. Yeah. Are they the loan originators and then they sell them off to private credit? Are they going to de-risk and then become that much more utilities with just wealth management clients? Is that the model that we're seeing?
It's certainly the model that is being forced upon the industry. This is kind of an existential moment for the banks. Jamie Dimon wrote about it in his annual letter. What is a bank in the future? And
sounds like Jamie Dimon.
Right? Because you have their businesses having to change under the weight of regulation. You have Apollo, their deputy CIO of credit, telling me, Jamie Dimon says we're dancing in the streets, but we think we're dancing with the banks, which is his call to action for the banks to start working with these non-banks so that they can be the lenders ultimately and the banks can be the intermediaries.
I'm going to finish with a Tom King question in honor of Tom, who's not here today, but this is what he would say. Are they hiding how much money they're making? When you hear these bad headlines elsewhere,
I know, exactly.
Is it burying just how much money they're making right now?
Privately, even in the past week, the banks are certainly kind of concerned about the public backlash and how much money they're making in this economic environment, especially because we're watching them lean more towards those big companies, the big institutions. Credit cards, look at Citigroup. It's interesting. The spending is actually plateauing at this point, which that is, to me, a sign of strain on a consumer balance sheet. They can't keep maxing out their credit cards. How long is that going to last for? And how long are they going to be paying their banks 23% on interest?
Citi up by 2% this morning off the back of those numbers from JP Morgan and Wells a little bit earlier. If you are just joining us, welcome to the program. On the S&P 500 right now, we are negative, down lower. We're off by 0.14%. In the bond market, I'm sure you want an update. We're down 8 basis points on a 10-year, 461.65. Blink and it'll change on a 30-year. Yields down by 8 or 9 basis points on a 30-year, Lisa, 477 after going through 5% last week, up 20 basis points at one point yesterday, then back down again. This is kind of crazy over the last few weeks.
And also to put into perspective, when we were sitting here yesterday morning, we were looking at 30-year yields that were down on the day, right? I mean, just to give you some perspective, and then it became the biggest one-day pop in yields going back to March of 2020 at the height of the pandemic. So you have to wonder, when we take a look at this market and understand the volatility stability, what's going to push it? Is it going to be the University of Michigan Consumer Sentiment Survey and inflation expectations?
I'm going to be long gone by the time you, Mitch, comes out. I'm not hanging around for you, Mitch.
You go on vacation.
Lauren Goodwin's going to talk about that of New York Life Investment. She'll be joining us at 8:30 Eastern Time. Your top story all week. Here's the latest. Israel calling for an evacuation of all civilians in Gaza City, giving United Nations 24 hours to move its staff from nearby areas. This headline just crossed moments ago, Anne-Marie. The United States working to establish safe areas in Gaza.
Yeah, they're talking with Egypt about this Rafah crossing. Also just crossing, Senate Majority Leader Chuck Schumer says he will be traveling to Israel this weekend. You're going to see a tremendous outpouring from the United States. We just had Secretary of State Antony Blinken there. Lloyd Austin is there today, and now we're going to have Chuck Schumer going over the weekend.
What was the phrase, standing shoulder to shoulder? It's been the phrase over the last few days, hasn't it? Coming up on this programme, Ed Yardeni of Yardeni Research, the man who coined the phrase bond vigilantes. And the vigilantes back after the price action we saw yesterday in the bond market right now. 30-year yields lower by 8 basis points. 10-year yields lower by 7 or 8 basis points at 462. And equity futures just a little softer from New York. Good morning.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I'm of the view that at some point in time, we're not there yet, but you're going to see some form of yield curve control brought in to stabilize the bond market. At the end of the day, financial stability is the unspoken mandate of the Federal Reserve. They talk a lot about unemployment and inflation, but when things really come to a head, financial stability is number one.
Is the US budget a financial stability risk? I tell you what, this conversation fueled so much feedback over the last 24 hours from both sides. Michael Schall there, the CEO of Marketfield Asset Management. Hours after that conversation, we had a 30-year bond auction, which did not go too well, and we had a big move at the long end of the yield curve. Here's the price action right now on a 10-year. Then I'll get you to a 30-year yield. On a 10-year yield this morning, yields down 8 basis points at 461.65. On a 30-year, Lisa, down 8 basis points this morning. At one point yesterday, a move of almost 20 basis points. But if you take it from the low of the session to the high of the session, the swing was more than 20 anyway. Ridiculous session.
I think it's good to point to that swing. The fact that we're not seeing any stability or resolution and that we're ping-ponging from one place to another from day to day shows the lack of resolve, the lack of understanding of what's behind these moves, and frankly, the lack of a consistent buyer base. And this, I think, was the point that we were hearing from with Dalip Singh.
It's the perfect day to catch up with this man right here. Ed Yardeni, president of Yardeni Research. And Ed, as I often say, but it's worth repeating, the man who coined the phrase bond vigilantes. Ed, you know me too well. You know the next question. Are the bond vigilantes back, Ed?
I think they are, yes, because it's certainly one of the reasons that the bond yield has soared from just under 4% on July 31st to over 4.5%, in a range really 4.5% to 5% recently. If we look at the 10-year, the 30 years have been higher. But supply clearly matters, and supply is a result of fiscal profligacy. It's fiscal policy is out of control. Monetary policy has actually been doing its job. I don't think the bond market or the bond vigilantes really have an issue with the monetary policy authorities. It's really well, you can see they can't even get a Speaker of the House.
And sometimes supply doesn't matter. Typically in economic downturns, people will be willing to finance the deficit, buy treasury bonds with exceptionally low yields. Ed, is this a situation that can be addressed with bad economic data? And what I mean by that is, will we buy this bond market? Will those auctions look better if this economy looks worse?
Well, for all the volatility we've had since the summer, I think we're clearly looking for a yield level at which the market will clear. And I think 4.5% to 5% should do it. So I think some of this recent volatility, as long as it's range bound, is actually a good sign that the bond market figures this is a good yield relative to the inflation outlook. I know there are a lot of people that were concerned about the inflation numbers, the CPI numbers that came out yesterday. But if you take out shelter, I always take out things that don't support my story. So if you take out shelter, the CPI headline and core were both at 2%, exactly at 2%. It's that, it's that shelter that's just way too blank too high. That's been the problem. And even in the latest number, it was a problem. But we know that lease inflation on new leases has actually come down substantially.
And I love that you said that. You take out things that don't support your story because it's what everybody is doing, and you can take out whatever data that you want and support whatever story you want to write.
Correct.
A lot of people are looking at the volatility of the bond market, and you heard Michael Shawel yesterday talking about how something will break and that will be something problematic for the market that the Fed is going to have to respond to. Do you have the same feeling, or is your response the opposite, that the resilience that we have seen in risk assets to date, in the light of such volatility, is a sign that it can continue regardless of what the bond market does?
Well, I've been in the soft landing camp since early last year, and I characterized it as a rolling recession that's hitting different sectors at different times. And something is breaking right now, and that's in the commercial real estate market. There's going to be a lot of things breaking in the commercial real estate market, and I think it's one of the reasons the Fed is probably done raising interest rates, because they realize that the bond market's been recently doing all the heavy lifting in monetary policy. With the bond yield up close to 5%, that's a disaster for a lot of commercial real estate deals that have to be refinanced, or the value of commercial real estate. So those things are going to break, very reminiscent of what happened in the early 1990s when we had the S&L crisis. A lot of things broke in the commercial real estate market. We did have a recession back then, but it was very mild. It was just the growth rate that was really hampered by all those problems.
Let's tie that together, because we heard from the Wells Fargo CEO saying that they do expect commercial real estate losses to increase. They are expecting loan losses to increase, even though provisions are not necessarily increasing as much as people previously expected. Is your sense right now that we're seeing things just soften and that we're not going to actually see anything break, and that basically it's all been priced in based on where we are in this cycle?
Yeah, well, I'm still in that rolling recession camp. And indeed, in some areas, it's starting to look like a rolling recovery. I think in the retailing sector, for example, consumers may very well be coming back to buying some goods. The single-family housing market looks like it's bottoming. But yeah, I still don't think we're going to have an economy-wide recession going into next year. I think it's the economy's resilience is going to be proven to be with us, and I think it's largely because of the consumer. And there's a lot of moving parts in the consumer. One of them is you got 75 million baby boomers that increasingly are retiring. And talk about excess savings. I know Jamie Dimon has been saying since May of last year that consumers are going to be running out of excess savings, and that's when we have a recession. But the baby boomers have a lot of excess savings in their retirement assets, something like $75 trillion. And as they retire, they're going to be spending those assets.
Do those boomers not like Dom Perignon, LVMH, Ed Yardeni? Was that not the canary in the coal mine?
Well, look, I think that the retiring consumers are going out to restaurants. They're taking vacations more often. They're flying. They're using hotels, motels, and these are all the areas where industries are very labor intensive. And I think it explains why the labor market's been so tight. It's very hard to have a recession with a record employment. I know employment's always at a record right before recessions, but it just keeps going on. It just keeps rising to new record highs. So as long as that's the case, I think that the economy's resilience is going to be attributable to the consumer. And by the way, we know that the fiscal policy is out of control, but part of that is because they're spending a lot, which is stimulative to the economy. Even those net interest payments that they have to make, somebody's getting them. Consumers are getting a windfall relative to what they had, past several years of much higher net interest income.
You sound constructive, Ed. It's good to catch up. Ed Yardeni, if you had any research on LVMH and consumer spending. Our producer just wrote in, what's the trade down from Hennessy? You see the spirit spending at LVMH, it was terrible.
Well, I
think
personally...
they were down 14% in that unit.
Do you like champagne?
Dom, yeah, sure.
Really?
Yeah, who doesn't like champagne? Lisa, come
Prosecco
on.
is way better.
Brahma, what?
I really don't.
Prosecco is a little bit better because it's drier.
It's drier, and it doesn't give me a bad feeling in my stomach. I can't do champagne.
Okay.
Just letting you know.
Yeah, but Dom Perignon is not necessarily...
2013 Dom, we'll hook you up.
Yeah.
All right, thank you.
It's a good one. Anytime. Programming note in the next hour. No drinking. Mohammed El-Arian of Bloomberg Opinion, Queen's College, Cambridge, Julian Emanuel of Evercore, Tiffany Wilding, PIMCO, John Stolfus, Oppenheimer. If that's not enough, Tom Keen's panel coming up a little bit later as well. We'll take some of that in about 30 minutes. TK sitting down with 3, 4, 5 panelists, I think, 2 of which the IMF's Gita Gopinath and also the ECB President Lagarde. That's going to be an interesting one, Bramo.
Especially given the stagflation talk that we've been hearing about and the fact that I saw one note from Deutsche Bank today talking about a double-dip recession in Germany and the potential for real pain there. In some ways, Europe has been in the crosshairs of everything this year, whether it's the war with Ukraine or some of the spill through from the turmoil in the Middle East. And that's really going to become at the forefront of her call as she talks about the euro and she talks about humdrum rates. She's got a real tough between a rock and a hard place kind of decision to make.
All of that coming up in the next hour. I can squeeze in this as well. Our good friend Shanali Basek taking over the reins of Bloomberg Real Yield. That's going to be very cool.
It's very exciting.
Is it still at 1 p.m. Eastern time?
It's still at 1
Good to know.
Do you remember when you ran it?
I do remember. How many months ago was that?
I think you started
I think it was at 1 p.m. It started at midday, then it went to 12:30, then I think it went to 1 o'clock, and it got moved around several times. But once we got to about 1 o'clock, I was like, it's getting a little bit late.
Yeah, especially because he'd have to really stick around for the University of Michigan sentiment survey.
I love sticking around for you, Mitch. What time is you, Mitch, out?
10 a.m.
I'll be straight out the door.
Oh, I know, 9:59.
Shanali, good luck. Looking forward to the program.
I
Thanks
like
for your
talking
coverage.
about bonds. I'm happy to stick around on a Friday.
I know you do. You like talking about banks as well. More from Shanali on the latest earnings on Wall Street. A little bit later on Bloomberg TV and radio. Equities unchanged on the S&P 500. Bond yields a little bit lower this morning, down 9 basis points, 460.62 on a 10-year. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance on a day of bank earnings. John Farrow off to his next property. Tom Keene is in Marrakesh. Luckily, Anne-Marie Herdern has not abandoned me, and she is alongside me, Lisa Abramowitz, as we carry you into 1 hour to the opening bell. We do get, of course, the earnings calls, 8:30 a.m. and about just now. We are expecting to hear from JP Morgan on their call. In the meantime, we are looking at basically completely flat S&P futures. Nobody knows where to go with all of the potential tumultuous action. We see the euro basically unchanged in the dollar as well. This is not a particularly exciting tape, 105.35. 10-year yields lower. This is where the excitement has been and continues to be. Down 9 basis points after yesterday. A massive sell-off in the price increase in yields in the 10-year after a 30-year auction was really, really weak compared to expectations, even though yields were the highest at the sale going back to 2007. And a bid to crude, and we haven't talked about this, but Anne-Marie, seeing crude up more than 4.5% really speaks to the concern right now as we keep hearing all sorts of rumors. And this is a rumor mill, and we are not going to edify rumor, but real questions around at what point we're going to lead to some sort of massive escalation.
Well, CEO Jamie Dimon today talking about the concerns he has around the world, and he particularly talked about the food market, global grain, and energy prices. Because if Iran was to enter into this conflict, you're going to have some serious concerns on the energy front.
We will keep track of that for you as well. At the same time, in a day of a lot of action, we're nearly 1 month into the UAW strike against the 3 auto makers in Detroit. We seem to be at a stalemate of sorts. UAW escalating the strike by walking out of Ford's most lucrative plant, the automaker saying its offer of a 23% raise is the best it can do.
We have reached our limit. We've actually stretched ourselves to get to this point. We're open to moving some money around within the deal that might fit the union's needs better. But broadly speaking, from an overall cost of the deal perspective, yes, we're there.
That was the president of Ford Blue. And joining us now, Bloomberg Detroit Bureau Chief David Welch. And David, this has been the question all morning. What's left? What are you expecting to hear at 10 a.m. from Sean Fain?
Look, he's really been very unpredictable. We didn't expect him to walk out another plant in the middle of the week, and it almost seems like a tantrum walkout almost, where he just got fed up and left the table. And look, he could add more plants here to see if he can possibly get any more out of Ford or out of the other companies. But it really does sound like Ford especially, but the others' offers are not far behind. Everybody's kind of at their limit of how much they can spend on this next 4-year labor contract. And they have a fixed amount of money that they can raise their labor costs for the next 4 years. And they've got to be getting pretty close to it. So we'll see at 10 o'clock this morning if UAW President Sean Fain thinks he can squeeze more out of them, or if maybe he's going to. I don't think we'll see a deal, but he could extend the current strike at the current plants while they just sort of finalize a deal if he thinks they're at the limit. Otherwise, maybe he adds to try to get more.
Ford officials said they were pretty shocked about the Kentucky plant. Did he pull this wild card too soon?
I don't know if he pulled it too soon. It almost seems like there was a misunderstanding between the two of them, or they were talking past each other maybe, because Ford said they made it clear they couldn't add to the economics of the deal, and he said, Sean Fain that is, said that the union was expecting to add, that Ford would add more to it. They're at a 23% pay raise over 4 years, plus a cost of living allowance, plus some add-ons to the retiree benefits for the workers, not a defined benefit pension, but adding on to those retiree benefits. The open question is, what's Ford going to do for future battery plant workers? Will they automatically be part of the union and pulled into this master agreement? Will they be paid the same? That could be an area of disagreement. But Fain was specific that it was economics. And look, this is a very rich deal as it stands from all three companies right now, and I think it would be ratified pretty easily. So I'm not sure how much farther the companies will go. And Sean Fain will either have to accept it or we're going to have to buckle in for a longer, nastier strike.
David, how can they promise workers jobs at battery plants that they don't even have yet?
It's complicated. There is some precedent for it. Ford had a plant in Michigan years ago that made dashboards, plastic parts, and that sort of thing. And before it opened, Ford agreed that it would be part of the national agreement. But you still do have to organize the workers. Basically, companies can pledge what they call a card check or a neutrality promise, where if half the workers simply check a card saying they're interested in the union, the company will automatically recognize it. And then the company can extend whatever wages and benefits they want to those workers once that's done. It's tougher to do in right-to-work states, particularly in the South, particularly in Tennessee and Kentucky, where Ford has a lot of manufacturing and where they're planning a battery plant. So it'll get very interesting to see how that's going to work out. But I think what the union wants is for the companies to automatically recognize these plants and then give them these master agreement wages once they get there. And I think that's where the fight will be, because EVs don't make a lot of money. A lot of them lose money, and promising top level pay and benefits to make batteries for vehicles that are losing money right now. I think you're going to see a wrestling match over that.
Bloomberg's David Welch, thank you so much, and I'm sure we'll speak with you soon to get the latest. Meanwhile, we have been getting bank earnings throughout the morning. They have been beating across the board, and we have seen record net interest income at JP Morgan, similar types of expectations for that to continue at the likes of Citigroup as well. Joining us now, Lauren Goodwin, economist and portfolio strategist at New York Life Investments. Lauren, what's your take of what the read-through is from the banking earnings we've gotten so far on the rest of earnings, and frankly, on just the role of banks for investors that have been underweight so far this year?
Well, the bank's earnings are telling us, frankly, what we already knew about the economy in the third quarter, which is that we are seeing some early signs of weakness in low-income segments of the economy, but overall, things are okay. We have to keep in mind that bank lending conditions and monetary conditions have been tightening for 18 months already, and so the likelihood that we saw a meaningful surprise here was relatively low. Now, if I expand that to the broader economy and earnings for Q3, I expect we might see more of the same. We know what's been going on in the real economic data, and earnings expectations have already been revised down fairly meaningfully, especially in cyclical sectors. So I think we may be able to see an average rate of beats, and recession just is nowhere to be seen yet.
So are you getting more bullish as you see some of these results?
On the economy, no. And that's because when we see the Fed raise interest rates, the economy tends to evolve in a very similar level. And what I'm seeing in the data and in the markets are signals of late cycle economics. However, until we see signs that recession is already here, the equity market doesn't tend to react to that. And so rising unemployment claims, earnings deterioration, those are the signals that I'd be looking for to get much more bearish in the equity market. They're not here. And so it's an environment where, while we may expect a little bit of sideways activity, lots of volatility, it's one in which it's important to be invested.
So sort of dancing in the twilight, basically trying to get to a place where you are capturing the dynamism of the near end of cycle or late cycle that you're talking about. It's something that other people have been talking about too. Are banks still leveraged to this economy, or are they independent? I'm talking about the biggest banks. Can you get long banks even if you see some sort of downturn in the near future, simply because they can capture the upside from higher rates? And they've been insulated from losses to such a degree with a lot of the regulatory action.
Well, two things are important here. First, absolutely, the banks are still leveraged to the economy. Because bank lending standards have been tightening, because they expect the economy to slow over the next several quarters, you do see revenues starting to slow. That's because loan origination is down, and the cost of deposits is going up, and the competition for those deposits is going up. For the big banks, though, and this is the second thing, they're diversified. They have fortress balance sheets. They have a lot of ability to navigate cycle dynamics as differentiated from smaller and regional banks where that scale is less beneficial.
How much are you concerned about potential paper losses from bond yields rising as much as they have and the volatility that we have continued to see? Have we seen the fallout from that? Or is there something that sort of feels ominous about what we've seen?
Well, the reality for the banks is that the Fed's term lending program is still intact and will be until next March. And frankly, if long rates are still high, as I expect they will be in March, that program would be, I think, likely to be extended. And so paper losses in terms of a risk to the broader equity market are not on the list. They're not a concern. Where they do play a role is in capital considerations for the banks. And that's, of course, something that we're going to be hearing. Well, maybe we won't actually hear so much about it yet today because the banks don't really know what they're going to look like. But that's an area where we expect to see some continued hemming, hawing uncertainty. One thing with respect to capital and increasing capital regulations for the banks is there is a bit of a point here in that capital is so important for the security stability of the banks. It's one of the reasons why the big banks are able to navigate these dynamic forces that we're seeing in the market. But what we saw in March was a lot more about liquidity. And so I'll be curious to see what the banks say about that balance of capital, fortress capital amounts, and then the liquidity of that capital in the future.
We've seen a lot of volatility in the past couple of weeks. Have you changed anything about your views?
Such a good question. We're vigilant in navigating the market, but I think the reality is until we hit recession, we are probably not going to see a definitive macroeconomic narrative driving the market. And as a macro person, what that means is this is a time to be thinking about quality, essentially hand things over to the stock pickers, hand things over to the bond pickers, and acknowledge that sector or style plays are unlikely to last more than a few days at a time when there's so much uncertainty.
You say you're encouraging investors to be very pragmatic and kind of stable at the moment while they look around what's going on geopolitically. What did you learn from Russia's invasion of Ukraine that potentially you want to keep in mind when we watch these events unfold in Israel?
Well, the number one thing that investors, I think, felt in real time with Russia and Ukraine is that the initial shock, the initial assumptions that are made about a geopolitical shock or narrative aren't always what drive the market in the medium and longer term. So the first couple weeks after the invasion, you saw proximate asset classes seeing the most impact. The Russian ruble, Russian equities, oil, some food commodities that we knew were relevant in the region. But 2 weeks later, the most impacted asset class was the German Bund. And that's because the narrative around the invasion became one of inflation, one of a broader global picture that geopolitical risk was entrenching rather than just that initial shock of oil. And we've seen the same thing this week. A little bit of a bid in oil prices on Monday. That's reversed a bit as markets step back and assess, okay, what really are the implications of what we're seeing in Israel to the region? So far, there hasn't been a meaningful impact to energy supply. And I think that's why we've seen some relief of that story. And then again today, with concerns that there might be an escalation, of course, the geopolitical picture changes. But there do tend in these shocks to be a stronger narrative that becomes clear. We just have to wait a little bit and see what happens.
And markets tend to be very patient. Lauren Goodwin of New York Life Investments, thank you so much for being with us. If you are just tuning into the program, the S&P is basically unchanged as we kind of fluctuate here. But now we are moving up 0.2%. We are seeing that yields now are down 11 basis points on the 10-year. 458.56. We are getting some headlines from the JP Morgan conference call with investors. Still with us, Shnelly Bassick, going through some of what we're hearing. What are we learning, Shnelly?
We are learning that he is still criticizing regulators. We knew that this was going to be happening, and we've been talking about this, the storming of the Hill. The banks are really fighting these capital requirements, this new Basel III endgame requirements. And as we know, those big banks, they're not going to even be impacted as much as those smaller banks. That is a big part of the story here. I've been looking back through his prior comments as well, this idea of how much things can get worse. What's interesting is this is the best third quarter that Citigroup has ever had in rates and currencies. If you look at that at JP Morgan, they beat on expectations, remember? But the value at risk being a little lower, Lisa, is telling you something about the risk appetite within these banks as the economy starts to get a little choppy here.
We will get a little bit more, or much more detail coming up with you. Anne-Marie, from your perspective, is there any appetite in Washington, D.C. to divert focus to scrutinizing banks more, given the fact that they need to get leadership and deal with a whole host of other
Well, it depends
issues?
who you ask, but to Shonali's point, Jamie Dimon has been talking about this for months. When Michael Barr came out and talked about stricter capital requirements, he said, great, this is a win for the hedge funds. This is a win for Apollo. This is a win for, in private equity firms. So this is a concern for the banks, but at the moment, the Fed looks like, and the regulators look like this is what they want to do. Because how do you have the past 6 months, we had 3 bank failures, and not act?
Right, especially with smaller banks, which might have the harder time actually developing some of the capital. Coming up, we will dissect some of these headlines, including the CFO of JP Morgan saying the pace of buybacks likely modest on capital proposal. Basically, modest is the word of the day when it comes to share buybacks, yet they will continue.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
One scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth, particularly if there's loan growth.
That was Ken Leon, Director of Equity Research at CFRA, after JP Morgan posted yet another quarter of net interest income that breached records, $22.9 billion in the third quarter, raising their expectations for the full year forecast. Similar type of move from others as well, and we are seeing that play out in the stocks as we see equities do better, especially in the banking sector. You can see JP Morgan Chase shares, which once were fluctuating about, now 1% higher as people parse through the results and get a sense of how much better. Also a sense that we are going to get share buybacks, although modest seems to be the word of the day. Wells Fargo shares up 2.7%, a beat across the board. Really, again, it's loan loss provisions that are lower than expected. It's net interest income that is higher than expected. It's banking revenues that are higher than expected. Fixed income trading revenues that are higher than expected. Equity is the weak spot, and yet still, the incredible strength is leading these shares higher. Citigroup shares also up 2.7% on the heels of this. Anne-Marie Hardern here with me. John's off preparing for the 9. Shonali Bossack has been parsing through the numbers, listening to the call for JP Morgan because she can do everything at the same time. And I'm wondering if there are any larger takeaways before we dig into some of the details from these earnings that we can kind of draw a conclusion on with respect to the banks?
Yeah, there's one thing that JP Morgan says that I think is very important in terms of caution for the industry that is so excited that things aren't so bad today. And he says these results benefit from our over-earning on both net interest income and below normal credit costs. What does that mean? Don't expect this to be normal per se. He raised his net interest income at least 3 times. There's a debate if it was a 4th time this year. And can you imagine to that many times say, we're going to make more money, we're going to make more money, we're going to make more money, and we're going to make more money.
Well, okay, but here's the thing. There's a bigger takeaway here, and John was asking this earlier, which is how much is this PR? And basically saying, don't look at us. We're not expecting to make this money. It just keeps coming through the door. Or is this something that is some sort of tea leaf of what they expect to come, and saying to regulators and saying to others, hey, it's not so great. We're not really making bank. It's just sort of a quirk of the moment.
There is a little bit of balancing here. Remember, they are taking to Washington again soon in early December. You have the big banks that will be facing lawmakers at the beginning of their annual grilling. I love listening to this one because they are making pretty stunning profits in this environment. But you know, they can also say, this is the U.S. consumer. This is a good thing. The consumers want to borrow. They're still spending money. You are seeing some normalization. You look at Citigroup, the kind of the spend here starting to normalize. These are things that show you things could start to turn a little bit here, but the strength of the consumer is keeping the banking industry strong, plus the comeback of these institutional businesses that are aided by these very complicated dynamics in the market.
They're going to really push back on potentially future bank capital requirements, aren't they, when they come to Washington?
There's going to be 2 objectives. From the banking perspective, they're going to be pushing back against those capital requirements. From the lawmakers' perspective, there's all sorts of other issues. Why aren't you lending to my constituents who want to buy a home? The housing market is still in dire straits in many places in the country. There's going to be that constant push-pull on ESG matters, especially with this concern about energy security around the world. There's also going to be a lot of questions about headcount, because besides for JP Morgan, most of these other banks are cutting jobs, not adding them.
One thing that you really should need to know about Washington when there's hearings like this is actually you think lawmakers in the room listening to every question, listening to every answer. They're actually not. They come in, it's very performative. They decide the point they want to make, potentially try to embarrass an executive, and then they leave.
Don't you just kind of want to go down there and buy them all a drink after? Like, it is such a long day. But, you know, speaking of long days, this sets us up for next week too, doesn't it? Because we do have Goldman Sachs, Bank of America, and Morgan Stanley starting to come in. Remember, what's interesting, a lot of money, yes, the consumer's holding up. The economically sensitive parts of the economy, as you see at Wells Fargo, auto lending, homes, still under pressure. But when you look to Bank of America, Morgan Stanley, these are wealthier client bases that we're looking at here that are borrowing for homes and still able to spend at maybe a greater scale than you're seeing at the weaker parts of the economy.
One thing that the JP Morgan CFO said on the call was that, as you mentioned, the full year net interest income guidance was up on, as you mentioned, Shonali, slower reprice. Does this basically just mean that they are not passing it along as quickly as they thought they would be to depositors?
And this is where that big versus small question comes into play again. JP Morgan is not passing it on as meaningfully as some of the smaller banks, where, you know, Jefferies in particular puts out this great chart about just how much deposits have repriced, because across the industry, they certainly have, just not at the biggest of the big banks that don't need your deposits.
So at what point does that become some sort of rallying cry? If you're getting so much money, why don't you pass it along to some of your clients that you have? At what point does that deposit beta play a role and really come under focus?
And it's also that question for consumers. Do you park your money in a JP Morgan where you know your money is safe, too big to fail, right? Or do you park it at a smaller bank where there could be some more worries, as we've seen earlier this year? Those smaller banks are getting a bigger rate, a better rate on your deposits. But to your point too, this has been highly politicized. The bankers have been directly asked, where is this money going if we're raising interest rates and you are not giving that money back to consumers?
Which raises the question of modest buybacks. And modest has been the word of the day. It's sort of, you know, something that we've seen as a theme in a lot of the banks. How much are we going to see in terms of buybacks? What will count as modest enough to satisfy investors and quell concerns by regulators?
It's a great question because the banking investor story, I don't know that it's hinging necessarily on those buybacks. They just want the numbers themselves to get better. But to the point you're making also, you can't sit there and return a ton of money to investors when you're laying tens of thousands of people off at most of these banks, right? The expense story and the use of capital is a massive tension and only getting more so by the day because wage pressure still exists at these banks too.
There's also a big theme, especially as we head toward Morgan Stanley, Bank of America, and Goldman Sachs next week, about why equity trading revenues disappointed and fixed income revenues beat. Do you have a sense of what was behind it? Is this a theme for the industry or is this an execution issue for both Citigroup as well as JP Morgan?
There's one big tell that shows you that this is a theme for the industry. You had three of the biggest investment banks in the world, Goldman Sachs, JP Morgan, and Morgan Stanley, on the Birkenstock IPO, and the IPO whiffed. And so that is a really big problem for the IPO market, this lack of equity issuance, this real scarcity here makes it tough to keep equity trading alive and well.
Sonali Basak, thank you so much. We'll be catching up with you throughout next week and throughout the day ahead. And of course, we're going to get those earnings from Bank of America as well as Morgan Stanley and Goldman Sachs next week. Anne-Marie Hardern, first, I just have to say thank you so much for being with us this week.
Thanks for having me.
Because it's always wonderful to have you. It's also such a pivotal moment down in Washington, D.C. and just globally. And I'm wondering what you're looking for, just sticking domestically for the moment, to understand whether we can create some sense of order in terms of even nominating somebody to take over from Kevin McCarthy as Speaker of the House.
I think it's pretty obvious the Republicans at this moment are struggling to coalesce around one name. Steve Scalise, who had the majority in conference, couldn't get to 217. They can only lose 4 votes. And at some point, if this continues to drag on, you have to think, is there going to be a centrist that comes out and says, I'm just going to reach across the aisle, give the Democrats something they want potentially in a ruling coalition, and then we have to get a speaker and we have to move on.
You know, you mentioned about the bank hearings on Washington, D.C., and you can see that actually any video shows that people come in, they make a point, they say something, they clip it, they put it on
Very
Instagram.
performative.
Right, they put it on Instagram and then they go home. And there's a question of whether Washington is losing relevance and whether they understand that. Do you get the sense that people are watching in Washington the perception and some of the market moves in response to what they're doing?
They watch perception, I think, more to their constituents back home. Obviously, they're always concerned about what happens in the markets if you're on the Financial Services Committee. But I would say that while, you know, in New York, people will ask me, well, why can't they just get this done? It's just not how Washington works. Someone in New York, they're thinking in a pragmatic way. I want to get to a bottom line. I want to maybe make money. That's not how D.C. works. Things just take a lot longer.
Which is the reason why a lot of policymakers are getting together and trying to figure out whether at least maybe internationally they can coalesce around something. And that is why Tom Keene is in Marrakesh, ostensibly, although we will be hearing a fantastic panel that he has coming up at 9 a.m. Tom Keene is sitting down with the IMF's Gita Gopinath, ECB President Christine Lagarde, and the WTO Director General at the IMF meetings in Morocco. You can watch the conversation in its entirety on Bloomberg at LiveGo. Right now in markets, we could see a little bit of a positive momentum as we see better than expected bank earnings across the board, 0.3% gain on the S&P.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the U.S.
Nobody covers business like Bloomberg. Context changes everything. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend, live from New York City this morning. Good morning, good morning. Your equity market positive on the S&P by 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, JP Morgan kicking off earnings on Wall Street. The Treasury market suffering from indigestion, with crude rallying on Middle East tensions. We begin with the big issue, the 30-year penny stock.
In terms of the bond market,
these sort of day-to-day moves are quite astounding.
A lot of this is whipsaw.
It's not just been the bond volatility of the last 7 days. It's really been the bond volatility of the last 3 months.
There's been such an incredible move in yields, particularly over the last month.
We've seen this huge repricing in long-end yields, whether you look at 10-year Treasuries, 30-year Treasuries.
When things move this quickly over short periods of time, there's unrealized losses.
There's still some concerns of weakness in the economy, still some concerns about international stability.
The situation in the Middle East is very volatile.
It is one more catalyst for volatility.
Over the medium term, it is, we think, inflation that's going to be underpin market direction. If it comes back,
that in itself is going to be another support for yields moving a little higher. I'd like to see them settle.
You're going to see the trend towards lower yields in the early part of next year.
The market is just trying to find its equilibrium right now.
It could be a volatile period.
I do expect this ongoing volatility.
The volatility this week has been immense. Joining us now to discuss, I'm pleased to say, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, wonderful to catch up with you, sir. It always is. Let's go through it piece by piece. The last 4 sessions. Tuesday, the 30-year yield down by almost 14 basis points. Wednesday, almost 14 basis points. Yesterday, up 16. This morning, down 10. Mohammed, what on earth is that?
It's lots of things, John, and thank you for having me. So the easy answer is Monday, Tuesday was about dovish Fed statements, lower yields. Wednesday, Thursday was about somewhat hotter than expected inflation, higher yields. Today is about geopolitical concerns, lower yields. So that's the easy answer. The harder answer is that we have lost all anchors to the bond market, all of them. We've lost the economic anchor, we have lost the technical anchor, and we've lost a policy anchor. So what we're seeing is this enormous volatility. So far, we are lucky in that when we have overshoots, it triggers some sort of reaction. If yields go too high, some people start wondering about locking in higher yields for longer. if they suddenly go down quickly, those who have been caught offside with massive positions, loss-making positions, take advantage of that. So the good news is there is a certain amount of range-bound dynamics, but nevertheless, this sort of volatility is simply indicative that we've lost all anchors for this bond market.
Well, let's talk about another anchor we've lost and another situation as well. Yesterday was a two-part story. You're right to point out CPI, small upside surprise, yields start to drift higher. Then we had this really soft 30-year auction in the afternoon. Mohammed, have we also lost predictable sources of demand when we get supply from the Treasury?
Yes, we have. And we're facing higher supply from the Treasury. So the most important buyer, the non-commercial buyer, the Fed is out. The Fed is a seller. That's gone. And don't underestimate the importance of a non-commercial buyer that buys in very big amounts and that is predictable. So the Fed is gone. There's questions about overseas buying. Japan, China. Big question marks, especially about China. And then there are the traditional buyers who have been caught offsides by buying too much when rates were artificially low. So there is a real question out there about who's going to buy this additional supply. And if the economy does not weaken, then the path of least resistance for yields is higher.
As things stand, Mohammed, then, does this compromise the Fed's approach to monetary policy?
Look, the Fed's approach to monetary policy has been compromised for such a long time. The minute you're late and the minute you mischaracterize inflation, you then have to go faster, and then you accelerate these dynamics that are taking place. So it certainly complicates it. I think there's a lot of question mark about this narrative that has settled into the market. Don't worry, the Fed will have to do less because the market's going to do more. It doesn't quite work that easily, but it is a very complicated policy outlook. You know, you got a nice warning today from the Bank of England governor, and he's been talking truth to the markets over and over again, whether it was during the LDI, whether it was the impact of inflation. And he said, look, don't get carried away. This is very, very finely balanced. They had a 5-4 votes, and he says, I expect this to continue to be finely balanced going forward.
Well, Governor Bailey had to deal with his own financial instability issues last year, as you indicated. Do you think the budget deficit in Washington, D.C. presents a financial stability risk?
It presents a macro risk, and that, in turn, if it's not well internalized by the market, could be a financial stability risk. The major financial stability risk right now is the unusual volatility. It tends to break things. That's what we've seen in the past. So far, the financial system has been incredibly resilient, and we should all be thankful for this. But this volatility, John, is not something you should sleep well about.
So, Mohammed, let's work through this together. Look at the yield curve right now, 2-year out to 10-year, negative 40 basis points. There is a theory that investors at the moment are unwilling to take on less yield on longer-dated maturities because we're still in a quite robust expansion. So either the curve needs to re-steepen to attract those buyers again in an expansion, or we need to go into a recession. Is it one or the other that ultimately solves this?
John, I can sit with you here, which I won't, and give you a number of potential outcomes, because neither the journey nor the destination is clear. Okay, the destination is not clear. There's significant disagreement about what's the equilibrium interest rate. There's significant disagreement on what will the economy look like over the medium term. That's the destination bit. On the journey, there's significant disagreement on how this journey will evolve. What will be the impact of QT, for example? We don't know what the lagged effects of all these rate hikes. So the problem that we're all facing is that both the journey and the destination are in play, and therefore it is very difficult to make a clear statement on what this curve is going to look like with a high degree of confidence. And you're talking here about the most important market in the world. This is the benchmark market.
How are you today?
For not just US.
Hopefully you're doing well. I'm going to place order for euro. Okay, the price I'm looking to place close, it will be 105.35. Okay, guys. So if you're looking to trade euro, against United States dollar. You can place your order at 105.35. Okay? Okay, guys. And I'll do it right now. We still have time, so you can as well place your order. Right here. Okay, 105.35. Okay, order placed, and I'll speak to you later. It soon look like we will get filled any minute, any second, and we'll be in. So you still have time to trade. Okay, not yet. We're still waiting. Come on. Come on. Yes. Order filled. We contract long position 1 pip with our contract cost 100 pounds. In your case, it all depends how much you want to invest, how much you want to trade. Anyway, I'll speak to you later. As soon as it will move to another direction, I will let you know what's going to be, how we're going to trade euro. Right now, as you can see, it moved lower, so you still have time to purchase, buy at lower level. Okay, guys, I'll speak to you later. Stay safe.
I don't know, John. I really don't know. Normally, you would say yes without even thinking about it, but there's massive supply coming. There's a step increase in supply coming. That's issue number one. And the traditional buyers are no longer there. So it's not clear. We should, by the way, draw a lot of comfort from the bank results with an important qualification. We should draw comfort because it points to resilient balance sheet, it points to resilient deposit base, and it points in JP Morgan's in particular to really good management. The qualifier is those banks were never the worry. It was the smaller banks that were the worry. And we should keep a close eye on those earning releases, in particular, the stability of deposits, what NIMs are doing, and asset quality issues. And that's what certainly I'll be focused on as we get more and more bank earnings releases.
Do you think we've left the stress of spring behind us? Is that behind us?
It's not clear what it is, John, because we've had another move up in rates. So we just need to keep a closer eye on this. It is very good news that the large bank, the globally systemically important banks, are doing so well. But it is not, they weren't the concern. The concern are the smaller banks. In fact, the larger banks may suffer because the reaction is going to be to increase capital requirements across the whole banking system. But keep an eye on the smaller banks. We're going to learn a lot in the next few days.
Mohammed, just a final word on the Fed if you can. Front end seems quite anchored now by the recent Fed speak we've had from the Federal Reserve, indicating that maybe November isn't going to happen. Is December still a live meeting for you, Mohammed, going into year end, given the inflation data we've seen so far this week?
John, the market says there's over a third probability that one of the two meetings is live. I hope it's not. I really hope it's not. But you know that I say that because not only do I worry about the lagged effects and the financial stability and growth effects, but I also do think there's a danger in trying to get to 2% too quickly. And if you look closely at the CPI numbers, and if you look at what's happening over the last 3 months, and if you look at the components of that, you will see why it is. Inflation has migrated in such a way that to get to 2%, you may end up crushing the economy and risking financial instability. So I hope they don't move either in November or December. I don't know what they're going to do. But behind that is a view that I know is not shared publicly yet by the Fed, which is we need to revisit the monetary framework. We need to revisit what is the right inflation target and how fast do we get to it.
And whether they'll ultimately tolerate higher inflation through next year and beyond. Mohammed, always a privilege, a pleasure to catch up with you, sir. Good friend of this program, good friend of mine, Mohammed Al-Arian, on the latest in this market. Here's the latest right now. Equities on the S&P 500, slightly positive. Let's get you some movers. Here's Abby.
Well, John, we of course had Shanali cover the banks, which right now are rallying on the solid results. So let's go elsewhere. And one stock that's rallying for the wrong reason, Dollar General, or at least the wrong reason relative
relative to the old CEO, Jeff Owen. He is stepping down, so the stock is up 7.3% amid workplace safety concerns. To the downside, though, Netflix is down about 0.8%. This as Wolf has downgraded on full ARPU expectations. Basically, the stock doesn't have too much more left there. And then Boeing down 2.2% as it's been revealed that one of its top suppliers, Aerosystems, that they're continuing to have supply issues, production, that MAX production issues, that it's worsening. So Boeing is down 2.2%, John.
Abby, thank you. The opening bell about 17 minutes away. Much more on some of these movers, including the big banks around the cash open with Shanali Basak. Let's turn our attention now to Marrakesh, Morocco, the IMF World Bank annual meetings taking place where my good friend Tom Keane is holding a special panel including ECB President Christine Lagarde. Let's take a listen.
To touch on migration here, but could please give us the growth outlook that you see out 5 years and the prescription Europe needs to do now?
Well, thank you so much, Tom. And let me first of all regret but fully understand and appreciate why Kristalina is not with us, invited by His Majesty to attend the opening of the Parliament of Morocco. I think is a great honor and should just reverberate on the quality of the institution and, if I may say, its depth and the depth of its bench, because it gives us the pleasure of not having another man, excuse me, but having another woman. So that's a real test of success.
You're looking at me, okay.
You're okay. All right, back to your question, because that's what you really want to hear from me. I would like to pick up on where Gita was and to tell you how we are seeing the situation now. And I put really the emphasis of now after the 3 mega crises that we have gone through in the last 3 years and the most recent developments that we haven't seen the end of and which will have, in addition to the human toll and the horrible developments that will take place, that will have economic consequences. And it feels very much like, and I want to point to my notes because I listed them and I want to mention them for you, what I would call the multiple moving parts. And we're just not yet too sure where the chips will come down. And I would list in my moving parts the unwinding of large previous shocks. And Ngozi has alluded to some. There are multiple previous shocks, from the disruption to the supply bottlenecks, to the immense volatility of energy prices, to the pent-up demand against the restricted supply, and all of that happening in a very abrupt and sudden way. So that's number one. Number two, something which is affected by lag time, or time lag, whatever you call it. And I'm not here talking about monetary policy. I'm here talking about the adjustment of wages to inflation. And there is clearly in everybody, in all central bankers' mind, the fear of the second round effect. Is it happening? Is it likely to happen? Are we at the peak, and are we now going to see declining wage increases returning to real wage a la pre-COVID? Question mark. That's another moving part. The third moving part is what I would call the strong. You know, we did 450 basis points hike in 15 months. Which is a huge, unprecedented increase. And this is what I call the strong but lagged policies. We haven't seen the end of it yet. We're seeing tightening of financing conditions like it has never happened before. We know that there is some more in the pipeline, and how it is going to impact our economies, how it will have deflationary impact, disinflationary impact in our region is also to be seen. And the final one, you know, sort of really ball in the air is the structural reforms that will come out of all that. There is what, Ngozi, you called the, did you say re-globalization? Mm-hmm. I would call it probably consistent with a good fight against climate change, the near-shoring, not reshoring, not friend-shoring, but reducing the distance, having a better handle and control over your supply chain and the logistic and transportation. That's just one example. I think the labor market is also a case in point where we will be seeing structural reforms and where the people who are joining the market now have different aspirations, different expectations in than what we had, but, you know, let alone the two grandmothers at the table here. All of you, the Z generation, will not want the same thing. So those are all these balls in the air. We're not exactly sure how they're going to land, but certainly we all have to focus on our policies as far as the European Central Bank is concerned. As I've said before, our aim, our mission is to return inflation to 2% medium term, and we will. And it is happening as we speak, and we will hang on to that, be steady, long enough, and ready to do more if necessary.
This sets up Joyce Chang perfectly. President Lagarde, and I say this with great respect for Bill Rhodes for years at Citigroup, do you ever feel like you're central banker to the world? I'm talking to you, Christine.
Oh, to me?
Do you ever feel like you're central banker to the world?
Central banker
You bring
to the
it
world?
over from the ECB over to the major central banks, feeling like they have a profound effect on EM and the rest? You talk about the monetary policy movements that we saw.
Look, I think central bank governors, presidents form a community. They're all driven by the same purpose. They have different mandates eventually, but I think their mission is to procure or restore price stability so that economic actors of all sorts, consumers, investors, savers, spenders, can actually anticipate what is likely to happen. And we have to do that in intelligent coordination with the fiscal authorities.
Right. Joyce, I'm so happy you're here. You gave us a bond market that we don't want to talk about. We're doing a debate on the global economy. You have a framework with Bob Michael at JP Morgan of a 2.5 inflation-adjusted 10-year rate of a 5.5 10-year yield out at some point. For those of you not versed in the world of Joyce Chang, that's stressful. And you and I talked about Barry Eichengreen's paper at Jackson Hole, which is a debt walkthrough of EM. And I'd like you to fold the constraints we have on getting to a more optimistic and better growth over to the challenges that we see with emerging market debt.
No, thanks so much, and it's just wonderful to be here with you, Tom, and with Gita, Christina, and with Ngozi. Well, we do think that the great moderation is over. We had put out a target, 2.5% real yields, we thought could be a sort of a medium-term target. Take 5 years.
Oh, her mic is off. Okay, well, we expected this. There you go.
Oh, okay, I'm sorry. Is that better, everyone?
That's much better.
Okay, great. No, so I think part of the problem, Tom, is, you know, the bond vigilantes are back. The great moderation is over, and the focus has come back to the fiscal and debt sustainability, and there's actually more talk about that at some of the market meetings than even about the soft landing and no recession scenario. And so I think the cost, you know, there's the resilience, but then there's the cost of that resilience that's really coming into market focus right now. So when we put out, you know, real yields, we think there'd be 2.5%. We were at -1%. And people ask me, how long do you think it could take to get there? I said, well, maybe 5 years. But, you know, we're practically there already. And I think, you know, this is kind of coming at an inconvenient time. You have the 30% increase in Treasury supply on long duration at a point where, you know, the Fed's not buying, the banks are not gaining deposits, the institutional demand isn't there. And that has very clearly put the focus back on the debt dynamics, the debt sustainability, and the fiscal debt and the cost of servicing the debt, given the size of the fiscal deficit. And the focus isn't on the emerging markets so much as it is on the advanced economies, particularly on the United States right now. I mean, in this period, I think EM has been, you know, very resilient. But I mean, we've also seen limping along. You know, fractured my foot, so relate to that. The limping along as well, where the medium-term growth, you know, does not look as optimistic. But we are, you know, once again, you know, getting a focus back on whether the financing is going to be more problematic. And it's hard to talk about emerging markets in one block because there's clearly the frontier market countries, and then there is the, you know, EMX China, the middle income countries, which have done a very good job. They started hiking a lot earlier. We think there's probably 150 basis points of easing they can do between now and the end of next year. But you do have the debt dynamics that are very much back in focus, and the debt service. But that's not just an emerging markets problem, it's an advanced economy problem as well.
It's interesting. Geeta, I want you to fold this in, and Geeta well knows there's the blue book, the green book, the brown book, and I wish you'd print them still instead of just digital, because I actually love the appendices and all this, the great work of your team at the IMF. But I'm going to go all Tobias Adrian on you right now. I listen to what Joyce is saying, and I listen to what I see on the Bloomberg screen, and the bond market is speaking about this growth constraint we have. On a Hayekian basis, how do we clear this system to move on to a better place?
So, Tom, the bond market is reflecting many things. For one, it's come to accept the fact that interest rates will have to be higher for longer, something the policymakers have been clear about, but it's taken some time to get into the market. But the other aspect, and this is the novel piece that Joyce pointed to, is we are seeing some pricing in of fiscal risks, which is usually unheard of when you think of the US market. You have a large amount of debt being issued at a time when you have quantitative tightening being done by central banks, at a time when Japan's rates have gone up, and therefore their demand for US treasuries are somewhat weaker. In that environment, what we're seeing is pressure on yields at the long horizon. Right? So right now there is a huge demand for cash, which is on the short end of it, but we're seeing a lot more volatility on the long end. And I want to take that to a kind of step back and make a broader point here, which is that if you look kind of around the world, it's particularly true of the US, but many other countries, we're seeing a looming mismatch between the spending needs of countries and the resources that they will have to pay for it. Now, there was a decade after the global financial crisis when that was less of a problem because you could borrow at ultra low interest rates and that was not an issue. But now you're borrowing at much higher rates and you have weak growth prospects. So this is a difficult place for countries to be. There's a challenge, particularly for emerging and developing economies who have important development goals that they have to meet the climate transition. But I think it is an important time for governments to think about how they're going to pay for all these spending needs without relying as much as they did on borrowing.
And Ngozi, I look at this and I look back at your wonderful article in Foreign Affairs. I can't say enough about it, folks. And there are these phrases from another time and place, GATT, most favored nation status. And now we have, as you write about, almost a blockism from pre-World War II. What is going to be the process that WTO can provide to get us to a better place? Here in Marrakesh, I'm very much listening for the processes recommended to jumpstart us out 5 years to better trade situation. What would it be?
Well, thank you, Tom. I think the one thing we don't recommend, let me start with that, is more fragmented trade. Because if we have the world, if we have trade fragmenting and people just trading with each other in blocks of people similar to themselves, this fragmentation, we've done some work, Geeta and the IMF has done some work that shows that the real losses to real GDP, global GDP in the long term are substantial. 5% in our case, they had 7%. And for emerging markets and developing countries, it would be in double digits. So and I will not stop saying this, it will become boring because we think that any fragmentation, if fragmentation spreads, then definitely we will not be able to get back on the good path. What I think we should look at to get us back in terms of trade, we need to avoid more protectionism. We need to avoid people retreating and thinking that, look, things are going so badly that I have to make sure that I rely as much on myself as possible. Because we've seen that global trade has rendered benefits in the long term. For the past 75 years, We've seen people lifted out of poverty due to trade. So let's not throw away what has worked in the past, but let's try and make it better. That's why we talked about the re-globalization. So let's avoid protectionism and putting barriers. The free flow of trade is what we need if we really want our economies to move. I think the second thing I want to say is that there are green shoots within trade, and that's what we're looking at the WTO. We look at trade, and even though, you know, our recent forecast has downgraded the goods trade, the volume of goods trade from 1.7% to 0.8, which is quite a dramatic downgrade and goes along with all the new pessimism that is emerging. But within that, there's something very interesting happening, and that is the growth of digital trade and digitally delivered services trade, which is growing at 8% per annum. Out of $32 trillion of trade, we've got 25 trillion that is goods, 12 trillion services, and of the 12 trillion, 4 trillion almost is digitally delivered services. So this is growing so fast, we're saying, what can we do to make sure that we foster this trade, that we make sure micro, medium, and small enterprises and women-owned enterprises that are the ones using this trade the most, that we remove barriers in their way, and that we put a level playing field so that this trade can grow even more. So that's the green shoot, and I think as we have all this pessimism, we should look at some of these optimistic areas.
With the time we've got 21 minutes left, folks. I'm trying to get an extension right now. We'll see if we get that. Ngozi, I'm going to come back to you at the end of this effort to speak of the huge opportunity of trade within Africa, and particularly when I look at the span of the IMF here from Nairobi 50 years ago over to where we are now. Christine Lagarde, when I first met you, you had just been at LSE Square Dancing. It's a few years ago.
We'll let that conversation continue with Tom Keene speaking to ECB President Christine Lagarde. I want to get you set up for the opening bow, taking place in about 20 seconds from now. Your equity market on the S&P 500 positive by 1/3% on the S&P. On the Nasdaq up by 0.2%. The S&P heading towards a second week of gains, even with all of that bond market volatility. This bond market all over the place. Equities with a lift. There's your opening bow. Check out the bond market. Treasury yield shaping up as follows. Yields on a US 10-year a whole lot lower this morning on a 10-year, on a 30-year as well. The 30-year this morning, looking at my screen on the Bloomberg terminal, lower by 9 basis points at 476. On a 10-year, lower by 9 basis points to about 461. The move we saw in the 30-year yesterday was a whole lot higher off the back of CPI and a pretty soft supply coming from the 30-year auction as well. Looking at the FX market, a euro 105.23, we're negative there by 0.05%. Let's get to one sector we want to watch at the opening bell, the financials. Big bank earnings kicking off with JP Morgan, Wow, Citi, all delivering better than expected Q3 results. But JP Morgan CEO Jamie Dimon delivering a warning, writing, quote, "This may be the most dangerous time the world has seen in decades." Sonali Basak has more. Hey, Sonali.
John, good morning. You have on one hand the most dangerous time the world has ever seen, and on the other hand, a surprisingly strong consumer in the U.S. economy, and that is fueling JP Morgan and a net interest income that has been risen in expectations for the full year for the 4th time this year. Now listen, when we listen to these conference calls that are getting underway here, there is a very measured tone, the risks ahead versus the opportunities today, and you do see JP Morgan still beating on most of the cylinders that it needs to be. Fixed income trading above expectations, net interest income remaining high. Yes, deposit betas might face some pressure here, but deposit pricing is still very competitive for a big bank like JP Morgan. Good point that has been made earlier by Mohamed Al-Arian, Bloomberg opinion columnist, this idea that the biggest of the big banks are not the ones that we're necessarily worried about. The regional banking system, as this continues on, are we going to see more strains in the consumer than we are seeing from the likes of JP Morgan and Wells Fargo? Because even at Wells Fargo, you are seeing fairly significantly calm markets when you look at the credit costs being associated by the loans being extended. The trends we're seeing in the economy here, this idea that commercial real estate, housing markets, auto markets are the ones that are more severely impacted, are certainly playing forward in the story for the biggest consumer banks. And for the biggest investment banks, both JP Morgan and Citigroup are not only beating expectations on the most important fronts, they're also telling you that things are starting to get a little bit better. Now, does that hold? It depends on how dangerous that economy gets. If things get stifling, everything could turn around. But you have the likes of Citigroup saying that debt underwriting is very significantly higher than what Wall Street expected, meaning they're raking in fees as institutions are willing to meet the market again.
Shanali, thank you. JP Morgan up by 2.5%. The broader market 2 or 3 minutes into the session, positive by 0.4. On the Nasdaq, up by 0.2. Let's stick with the banks. Baird's David George weighing in after JP Morgan results, writing this: while these were solid results, we don't expect a meaningful reaction either way on the heels of the print, given how crowded the stock is currently. He has a neutral rating on JP Morgan and outperform on Wells Fargo. David George, I'm pleased to say, joins us right now. David, always great to find some time with you when we start to get the bank earnings coming out. You said coming into it, the setup was compelling. Do you like what you hear this morning?
Yeah, we do. For all of the fears out there, John, around this bank so-called crisis, the earnings so far that we've seen have been quite good. JP Morgan made over $13 billion in the last 3 months, and Wells and PNC also had very good numbers. So I think what it shows, John, more than anything, is just the resiliency of these business models. And despite all the machinations of rates and credit and capital, the earnings stream and the revenue streams of these banks is actually quite annuity-like or utility-like in nature. So we feel pretty good so far to start these earnings season.
David, you know the concerns coming into earnings season. There were two of them. Loan growth was subdued, net interest margin moving in the wrong direction. Any reason to believe that turns around anytime soon?
So loan growth is going to remain relatively soft, we think, over the near term, and that's just a natural reaction function of higher rates, and that's the intention, I believe, of the Federal Reserve, is to slow economic activity broadly, and we're starting to see that. In terms of net interest income and net interest margins, we're of the view that we're within a 2 to 4 quarter period of a bottom in net interest income and net interest margin. And keep in mind, despite the fact that funding costs have gone up considerably as the Fed has tightened over the next couple of years and really the next 18 months, we think there's going to be fairly significant asset repricing in the form of loan yields picking up as well as securities yields. So there is a benefit that we think that the banks are going to experience, and the stocks are priced for permanent impairment and profitability, John, and that's just something we do not believe is going to happen, and the stocks, by and large, are way too cheap in our opinion.
Certain banks, as you know, are in the penalty box given what's happened with the bond market through much of this year. Is that what we need to get the likes of Bank of America out of the penalty box? A bond market rally? Is it that simple?
Well, I think that will certainly help. I mean, if you look at just what bonds are doing, banks tend to be, if bond yields are down, banks are trading up. So clearly, this OCI or bond loss fears are still kind of front and center in bank investors' minds. I think that will help to some degree. And honestly, a higher for longer environment for banks is actually pretty good. There's just a timing issue with respect to how quickly liabilities reprice relative to assets. And again, over the next few quarters, we think there's a nice opportunity to get some mean reversion, as it were, in terms of both ROEs, and net interest margins for the banks broadly.
Hey, David, we'll let you go. As always, thanks for carving out some time for us for bank earnings. Every quarter, David George there of Baird on the latest. Let's talk about that bond market. Trying to find some stability. Yields lower by about 8 basis points on a 10-year, 461. Broader market 6 minutes into the session. Equities up by 0.5%. With us now is Evercore's Julian Emmanuel, Oppenheimer's John Stolfers. Julian, I'll come to you first, buddy. I know that what we've heard from the banks is basically in line with your outlook. Right now is okay. Next year, I've got no idea. Julian, is that what you heard from the banks this morning?
I don't see how you can draw any other conclusion, John, because, think about it. They're raising their numbers for 2023. Some are not willing to give a great deal of guidance for 2024. And then Jamie comes out and makes that statement about the world being a dangerous place. And I think the environment where you see the banks ripping and you see oil and gold ripping together this morning tells you that the world is a dangerous place.
The world's a really dangerous place, John. We're being told that time and time again, but then this is what you hear. This is the reality of quarterly numbers from JP Morgan. The bank raised this year's net interest income forecast. Provision for credit losses, net charge-offs were less than expected. John, what should I pay attention to? The fears about the future or the better reality that we've had compared to expectations?
I think, Jonathan, I think where we are today is the world is never a safe place. I've been in this business since 1983. And I think probably the best year we had was 2017, and people complained that there was no volatility at that time. But looking at it here, I look towards the future, but I think the numbers that we saw today show that the diversification of business, really terrific management, and the ability to access clients and help those clients makes good sense in the financial sector. And we think very much, I think your prior guest from Baird said it very much in our viewpoint, is we do think that things are actually getting better, even though interest rates are higher. We think the end of free money is a good thing. It's a much healthier environment.
John, for your bullish outlook to work, though, do you need bond market stability? And when I say bond market stability, I've asked this question this week so many times, does that mean lower yields or just smaller moves?
I think smaller moves, John, and where we are today, we're beginning to see the bonds really trade in a range from a relative low to a relative high. And it says the bond market is looking ahead and figuring out that the Fed indeed is getting it right, even though it is not infallible. Its mandate is relatively simple. Yet it is a complex process to arrive at success, but it looks like it's doing it.
Julian, do you agree with that?
Yeah, absolutely. From our point of view, when you think about the long term here, earnings drive stocks in the long term. And there is a history of stocks going higher in an interest rate environment similar to where we are now. And basically, from our point of view, it's no coincidence that as much stress as there is in the world today, bond yields are actually lower on the week and stocks are high. That's a narrative that works.
There's some risk aversion out there through the week. It's not just the Fed speak, not just the data. There's some real risk aversion driving yields as well. I want to come back to something we heard from LVMH, Julian. LVMH essentially calling the top, the end of the post-pandemic consumer boom. And Julian, I know I say this with a lot of snark, but are they the canary in the coal mine from what we're hearing for the consumer?
So a company like that, there's no question about the fact that they have boots on the ground into the health of the consumer. And there's a lot of academic literature written about when that pandemic excess savings is going to wear up. We think you're still okay till the middle of next year. And if the labor market holds in, the consumer will go on longer. But confidence is very, very fragile, again, given high oil and all these crises we seem to be facing.
John Stolfus, has that pandemic era saving story played out?
Well, I think what we've seen is a much more prudent consumer than we've ever seen before. During the pandemic, they paid down some of their debts. They did spend, but they seem to be spending within reason. And I think part of that is that the consumer today is much more sophisticated just by virtue of all the information that just moves towards them on a daily basis. And you can see that within some of the negative positioning in terms of sentiment in the University of Michigan and Conference Board data that comes out. But yet in actuality, they continue to spend, they just shift their spending. Related to luxury goods, I think it's probably that there's just so much you can do within luxury space until you create a new excitement that brings out the luxury buyer. And also the effects of China's economy on the luxury market, I think, is really what is the big statement when it comes to luxury.
Julian, let's finish on energy. Brent crude up this morning by 3.5%, just short of 90. WTI up by about 3.5% as well, just short of 86. Julian, the focus there is about whether Iran is directly implicated for the massacre that took place over the weekend in Israel. How Israel responds to that remains to be seen. Julian, how are you and the team processing that, just in terms of the markets?
So what's interesting to us, and I think important to focus on, is that we've had extraordinary gyrations in oil over the last week or two, and actually going back several weeks. And at the end of the day, you're still range bound. Now, if you start breaking towards $100 a barrel, clearly that is more risk coming in to the geopolitical environment, and that is something that is likely to impact the consumer negatively. We don't see that yet, but obviously next week is a new week, and what could happen between now and Monday, we'll just have to see.
Julian, the unknown. The unknown. I'm with you. 2024. No one's talking about 2024 because we're absolutely clueless as to what is around the corner. Julian, thank you. John Stolfus, to you as well, buddy. It's good to see you. Have a good weekend, gents. That's 12 minutes into the session. Equity shaping up as follows on the S&P. We're positive by 0.5%. There is a rally in the bond market today. Yields are lower by about 9 basis points of 461. A rally in the commodity market as well. Brent crude, 89. WTI, around about 86. Coming up, a messy week for treasuries.
We have lost all anchors to the bond market, all of them. We've lost the economic anchor, we have lost the technical anchor, and we've lost the policy anchor. So what we're seeing is this enormous volatility.
Tiffany Wild of PIMCO up next.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
We have lost all anchors to the bond market, all of them. We've lost the economic anchor, we have lost the technical anchor, and we've lost the policy anchor. So what we're seeing is this enormous volatility. So far, we are lucky in that when we have overshoots, it triggers some sort of reaction.
Mohammed Al-Arian weighing in on the volatility this week. PIMCO's Tiffany Wilding looking ahead to the rest of this year, writing this. Markets appear priced for a benign economic outcome that would be a historical rarity given current conditions. Higher bond yields offer resilience amid increasing risk to the global economy. Tiffany, I'm pleased to say, joins us now for more. Tiffany, wonderful to catch up with you. It always is. You think both growth and inflation have likely peaked. What are the sources of demand, Tiffany, that you and the team think are fading?
Yeah, you know, so this is something that's obviously been discussed quite a bit, but we had just amazingly large transfers from the government sector to the households and businesses, for that matter, during the pandemic, and that created just a very large, you know, positive economic overhang that I think we're just still working through. You know, so Milton Friedman famously said that monetary policy works through long and variable lags. Well, in this case, fiscal policy is also working through long and variable lags. You know, but the thing is that you know, higher inflation and price levels is eroding the real value of those, you know, positive excess overhangs, you know, and we think that they are diminishing, and, you know, and the resilience that you're seeing in economies, you know, that's set to fade. So we would be careful about over extrapolating that, and we think the markets maybe have, and they're just not pricing in a high enough probability of recession.
Tiffany, as you indicated, that positive excess overhang was a consequence of a major fiscal transfer from the sovereign balance sheet over to the consumer. Is that leaving the sovereign balance sheet in a precarious position?
Yeah, well, obviously government debt levels, you know, are much higher. That's not only in the U.S., that's everywhere. And that's going to impact policy moving forward. And, you know, what that's meant to us, you know, is just that there's going to be less room and less capacity, less willingness to, you know, to implement more if, you know, in the future as the economy goes into a downturn. You know, and by the way, it's not only the federal government balance sheet or debt that's more elevated now, but of course central banks also have larger balance sheets. And we think there's probably going to be some fatigue there as well. So you're not going to see the type of policy response, you know, that we've seen from the past two crises, you know, the great financial crisis as well as the pandemic. You're just not going to see that in our minds moving forward.
So going forward, what do you think is the new reality? What are we going back to, Tiffany?
Yeah, you know, so we've discussed, you know, for several years now that this new reality that we're moving into, you know, is somewhere different from, you know, what economists called the Great Moderation prior to that. So we think we're just going into a more volatile world, you know, and that's also being exacerbated by the fact that they're just secular transformations that are happening. You know, we've obviously all talked a lot about the transformation towards renewable energy, but there's also transformations that are happening, you know, geopolitically as well, right? And that's just creating a more volatile environment overall. So this is something that we're going to have to deal with, unfortunately, moving forward.
The Federal Reserve might have to try and deal with some of these issues as well. For the Fed, Tiffany, what we've heard so far from speaker after speaker is they're comfortable allowing the bond market to do the work for them. Does that mean November's no longer a live meeting for you and the team?
Well, you know, I think it's a close call, quite frankly. You know, the data that we've seen more recently has just been stronger. The labor market report obviously was very strong. And the more recent inflation report that we got yesterday, you know, just kind of showed the underlying trends, these super core measures that the Federal Reserve is very focused on. They're just not going in the right direction, unfortunately. It's right that the bond market adjustment that we've seen over the last several months is tightening financial conditions, and that is doing the work for the Fed, you know, but I think it's possible that the Fed might just want to take out some insurance and might want to try to lock in some of this additional financial conditions tightening with another rate hike. So, you know, we think it's, you know, ultimately a very close call at this point. You know, but I think the broader issue here is, you know, at what level of the, you know, of rates and financial conditions, you know, do we really need here to start to really, you know, cool economic activity and ensure that inflation's back to target? And I think the bond market and the Fed is still searching for that level.
Tiffany, it's interesting you say that, because all indications we get from the Federal Reserve is they believe we are sufficiently restricted. If we're not, we're only 25 basis points or something like that away from it. Would you push back against that?
You know, I think there's just a lot of uncertainty right now in general. You know, and as I said, you know, there's a lot of economic volatility. The pandemic situation was obviously very unique, as was the war in Ukraine, for example. And just, you know, the traditional economic models, you know, are just not set up for that kind of supply shock. So, you know, I think there's a lot of uncertainty. You know, we agree monetary policy is restrictive. As I said, we think the probability of recession here is quite elevated. You know, but there's some uncertainty around that, obviously. the Federal Reserve is dealing with that uncertainty by treading lightly, by going slowly. Now that policy is in restrictive territory, they're trying to probe for those levels of restriction that bring the economy more into balance. But again, we're not exactly sure where that is, and it's certainly possible that we haven't hit it yet. But on the other side of that, it's possible that we're already there. Monetary policy works through lags, and certainly we could come to a point where the economy is slowing more than Federal Reserve officials expect, and it looks like policy is too tight.
Tiffany, thanks for the update from you and the team. Tiffany Wilding there out of PIMCO on the latest on the bond market and what we can expect from the Federal Reserve and the US economy. The broader market right now, 22 minutes into the session, higher by 0.5% with some sector price action. Here's Abby.
The breadth this morning, John, is excellent. We have many sectors trading up more than 1%. Utilities, energy, financials, healthcare, consumer staples close. However, those mega cap tech stocks, those sectors are just up ever so slightly. So the gain, while solid, isn't as robust as it would be if those sectors were also participating. On the week, though, all 11 S&P 500 sectors are rising. We are looking at a second up week for the S&P 500 in a row. And take a look at the banks, the S&P 500 bank index on these strong results. Well, it is up 4.4% on the week, and that is the best week since July 21st. So a little bit of a comeback here for the banks, John.
Abby, thank you. Coming up next on this program, your day ahead, your trading diary.
I was putting so much pressure on myself. And when I changed my mindset midway through the tournament and just approached it one game at a time.
Lloyd with Morgan streaking. She's chipping the goalkeeper! Off the post and in! Hat-trick for Lloyd!
I went from really just being under the radar to suddenly being in the spotlight.
You know who I'm talking about, Carly Lloyd! Carly Lloyd! Ladies and gentlemen, we have an American hero.
I had speaking engagements, sponsors that wanted to sign me, appearances, you name it, I had it. It became very mentally draining for the next easily couple years because I was extremely busy. But I knew that if I'm going to have any type of retirement, any type of financial stability when I'm done playing, I had to take every advantage of my opportunity.
Towards another week of gains on the S&P, gaining here by 0.6%. That's the price action. Here's the trading diary. Coming up, huge consumer sentiment at the top of the hour, plus President Biden speaking at 3:15 Eastern Time. Tuesday, earnings from Bank of America and Goldman Sachs, plus we'll get US retail sales. Wednesday, results from Morgan Stanley and Netflix. And finally, Thursday, Fed Chair Jay Powell leading a busy day of Fed speak. All of that in the week ahead. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City and points beyond to our worldwide audience. We're broadcasting live from Commonwealth's 2023 National Financial Advisors Conference at the Gaylord Rockies Resort in Aurora, California. Coming up, we're going to check in with Matthew Jessup. He's the CEO and managing partner with Jessup Wealth Management, get his thoughts on these markets. And then we really need to get some time with Allison Williams. She's the senior global banks analyst at Bloomberg Intelligence. We're going to have her break down some of these bank earnings we've seen this morning. They seem a little bit better than expected. So good news from some of the first banks coming forward with their earnings.
Dude, did you see the UMich
let's go to
inflation expectations?
No, let it rip.
University of Michigan one-year inflation expectations, we were looking for 3.2%. They came out at 3.8%.
Oh, boy.
That's the wrong way.
Inflation still with us here. All right, let's go to Nathan Hager. Let's get a kind of a reset here as we start the Bloomberg Markets program.
Yeah, the inflation expectations may be going the wrong way, guys, but stocks are still pointed higher. It is all about earnings, the kickoff of big bank season, and investors like what they see. We check the markets for you all day long here on Bloomberg. Right now, the S&P 500 is up 0.4%, up 18 points. 4368 is the S&P level. The Dow is up 0.2%, a 225-point gain, 33,857. And the NASDAQ is a little changed, up about 0.1% or 12 points, 13,586. Big beats all around for the big banks. JP Morgan Chase with another record quarter for net interest income. Wells Fargo raised its guidance. Citigroup's fixed income traders had their best quarter in at least 8 years. Ken Leon, director of equity research at CFRA, though, says it's still an open question whether these higher interest rates we're under are a positive for banks now.
One scenario that hasn't been talked about, with the Fed possibly with a rate pause, is that with rates staying high, and if the banks can hold the line in terms of deposit costs, they can enjoy net interest income growth, particularly if there's loan growth. But one of the worries we have is that still 25 to 30% of total deposits are still non-interest bearing that can certainly shift and go to higher deposit costs.
And just looking at the bank stocks right now, JP Morgan Chase is up 4.6%, Wells Fargo is up 3.5%, Citigroup up 2.9%. Seeing big moves in treasuries as well, with the 10-year up 19/30 seconds, the yield there down to 4.61%. The 2-year yield is at 5.05. NYMEX crude is jumping up 3.5%, up $2.90 at $85.84 a barrel. COMEX gold up 2.1%, or $40 at $1923.20 an ounce. It's the first time in about 2 weeks that gold's been above 1900 handle. The euro 1.0517 against the dollar. British pound 1.2161, and the yen is at 149.65. Hedge funds will likely soon have to start sharing significantly more information about short sale transactions with the Securities and Exchange Commission. The SEC is set to finalize new rules today requiring hedge funds and other big investors to report gross short positions in certain stocks at the end of each month. That's a Bloomberg Business Flash. Bloomberg Markets is on now with Paul Sweeney and Matt Miller.
Nathan Hager, thanks very much for that. Nathan Hager there with a look at your world and national news. Right now, I want to bring in Bailey Lipschultz. He covers stocks for us over at Bloomberg News on the other side of the building here. And I mean, what a day to cover stocks, right? We had a slew of big bank earnings just coming out rapid fire, beating estimates. We had Microsoft completing its $69 billion acquisition of Activision, and we had Novo Nordisk raising its outlook once again because everybody wants in on these obesity drugs, yours truly included. What are you looking at, though?
No, I mean, you hit the nail on the head. We're seeing a good smattering of green on the screen. That U-ish sentiment did weigh on indexes just a touch, but now still up. You're seeing the S&P 500 up 0.4%. But as you mentioned, big bank earnings beating expectations. JP Morgan up 4.6%, was up, extended those gains at one point to north of 5%, biggest day since April. Net interest income at a record. Jamie Dimon, though, did talk up some risk concerns, uncertainty about everything going on as it relates in the Middle East and other issues going on around the world. But when you look at these results, you look at what these companies are able to do, big banks, whether it's JP Morgan, Citi, Wells Fargo, topping expectations, Progressive beating expectations and up 7.8%, ticker PGR, Allstate trading higher, ticker ALL. Like, we are seeing the fundamentals come back into what these companies are actually able to accomplish. And when you see beats across the financial sector, you see the updates, as you mentioned, from Novo Nordisk, where you have United Health, ticker UNH, up 2.3% after results. It's a good day for stocks.
The other thing we're seeing is yields coming back down, right? The 10-year now at 461.24. We saw an amazing jump in yields yesterday that pushed markets off, and now that yields are down, does that mean equity markets are on the run higher again? I mean, is it that simple, dude? Are the correlations that strong?
Yes and no. We haven't really seen, actually, when you look at the data over the last few weeks, we've seen bonds and stocks getting beaten down. We are seeing that correlation actually kind of being thrown out of whack just a touch. But if you are looking at that, as you mentioned, you have the 10-year down, 8 basis points right now. When you have a day where yields are down and you have positive fundamental news from corporations, in some of the biggest corporations here in the U.S., it's really a double barrel victory for investors. One thing that does stand out that's kind of interesting, again, given all the uncertainty and kind of things going around the world, you do have gold right now up 2.3%, back north of $1,900 an ounce. So one thing to keep an eye on is where investors are putting money towards, whether that's U.S. equities, whether they're buying gold. We do have crude oil right now. I'm trying to wait for my screen to load, which it is not doing.
What, you're waiting for GLCO?
I use CL1 commodity. But
oh, you do? So I mean, CL1 and CO1 commodity, that's how I used to do it when I was a kid, Bailey. Now I just type GLCO, and that gives you the global commodity prices screen. You can see WTI crude is up 3.33%, as is Brent crude. So they're both gaining just about the same amount right now. West Texas Intermediate trading at 85.66. Brent, the global benchmark, trading at 88.85.
So yeah, that's a thing I should keep an eye on, Matt. The more time I spend with you, the more things I learn, to be honest.
Have you ever used ECAN Go?
I did. I think
it's like my favorite new function, ECAN Go. You can break down most of the big economic releases with this function, and you can dig deep into them.
That's how you sound really, really smart on X, is when you basically let the terminal do the work for you, and then you come up with these tweets, and people are like, ah, yes, that's a really smart person who works at Bloomberg, but in reality,
yeah,
terminal.
Just follow Michael McDonough and retweet what he does. Bailey Lipschultz covers stocks for us over at Bloomberg News. Thanks very much for that. Paul, let's get back over to you at the Colorado conference.
Yeah, we're broadcasting live from the Commonwealth's 2023 National Financial Advisors Conference. We're at the Gaylord Rockies Resort in Aurora, Colorado, a world-class water park. I will report for those that are into the water park thing. What we're doing here, there's a lot of registered investment advisors here. People manage money for others. They gather here along with their platform, the folks at Commonwealth. Matthew Jessup joins us. He's the CEO and managing partner of Jessup Wealth Management. So, Matthew, you've been in this business a long time. You started at UBS Wealth Management.
Correct.
Then you go off to form your own firm. Why do you go off to form your own firm? And talk to us about, what it was like building that business.
So, Paul, when I got started in the business, that was back in the day of, cold calling, right?
Yep.
Smile and dial. And I was able to build, a client base. And in the late 2000s, you go through the GFC, the last thing I wanted to worry about is the custodian where my money was held. And, being independent gave me the ability to invest money the way I wanted and grow the business in my fashion. And it's worked out really well over the years. We're managing over $300 million of assets, over 400 households across the U.S.
So how do you build that business? What are some of the tools you use to build that business?
So, a lot of it is going to be word of mouth and referrals. I do it old school now these days. The days of smile and dialing is obviously over. But, if you look at, how the business has grown, it's mainly through that word of mouth through our entire client base.
In terms of what you do to get your message out there beyond word of mouth, I'm thinking about social media, posting on Twitter, for example. Yes. Bailey was just talking about putting charts up there. Or maybe even going a little bit further, a YouTube account or a podcast. What do you think are the best bang for your buck ways to spread the word?
Matt, great question. For us, it's going to be our podcast. So we started the Independent Advisors podcast. We've been doing it for 222 consecutive weeks. Each of those podcasts lasts about 30, 40 minutes. And what we do is a really good job of educating our client base and potential clients. We're going to talk about big news and headlines over the past week. We're going to highlight, tweets or X's, articles, and research. And then we do financial planning topics of the week. And this was started with me and my business partner, Mark McEvely, who is our firm's chief investment officer.
So what do you find that your clients need the most these days? I mean, if you kind of just lose yourself in social media or in the news, it can be dizzying. So, I mean, how do you try to get your clients to focus on?
At the end of the day, it's helping them meet their long-term financial goals and avoiding the short-term noise. And if we look at the market day to day and react to that, we're going to get them off base. And so I think we do a good job putting the news headlines into perspective. Let's take geopolitics as an example. If an investor was waiting for the absence of geopolitics, they never own stocks.
Right.
And so I think we do a good job managing and balancing what they're seeing day to day in the markets, Paul, and managing that with their long-term goals.
So how do they think? I mean, everybody's different. Everybody's got different goals here. When you start off the conversation, kind of, where would you like to take them for most of these people? Is the 60-40 portfolios still the place to start, or is there a different place?
For a lot of retirees, I think that's fine. I think that the 60-40, due to the way the market was in 2022, is getting a bad rap lately. Yep. We don't think it's dead. I think ultimately, the way our firm manages money, we don't sub anything out mainly to third parties. We're using individual securities. We do our own research, and we have our own in-house trader. And right now, I know we're going to get to it in a little bit, we're overweight equities right now. We have a different contrarian view than Wall Street right now.
Why?
Well, ultimately, we think that Wall Street is too pessimistic right now. I think when you look at a lot of the indicators, Matt, it could be everything from investor sentiment, or you look at a lot of the extreme ratios we've seen over the past year. I think the market can't get around the fact that stocks can do good in higher interest rate environments. You know, NYU did a great study that looked at 4 variables: rising rates, falling rates, rising interest rates, falling, with inflation on the other 2 variables. And when you look at those and all those scenarios of falling interest rates in inflation, ultimately stocks only do bad in one of the 3, and that is going to be a rising inflationary environment. And ultimately, we are seeing inflation come down. It's not going to come down every month. We know that data point just recently, but we're making a lot of headway, and these Fed rate hikes take time to work themselves through the system.
Yeah, fair enough. Hey, I want to know about your take on the long end of the curve here. I think a lot more people have been learning about it. Certainly, we've seen massive inflows to TLT, which is 20-year plus bond fund ETF, and one of the things that I think people are noticing is small moves in yield contribute to very big moves in principal on the long end. But a lot of your investors, a lot of your clients may be looking at, say, the 30-year at 4 3/4% and saying, I don't care about moves in the principal over the time because I'm going to hold this to maturity. Those rates look juicy. Are they going to look juicy when we look back in 10, 15 years?
Well, Matt, I would kind of take the other side of it. Right now, we're on the short end of the curve because the big concern for us is ultimately rates are going to come down, we feel, over the next couple of years. And what we're going to look for is a definitive move in consistency before we start locking in some of those longer term rates. Now, I don't think I'm unique in that feeling ultimately, but I think at a certain point, owning individual bonds for our clients takes away a lot of the risk that you just mentioned, sir.
All right, so Matthew, talk to us about some younger investors. How do you go out and try to attract younger investors? Because a lot of folks are just concerned that maybe they're not saving enough early enough. Maybe they're not, because they have a lot of challenges, whether it's student debt or other things. How do you approach some of the younger investors out there?
Great question, Paul. So you and Matt were just talking about, presence on social media. If you look at these next generational investors, they're looking towards professionals that can guide them and provide that advice, but they want to connect on a personal level. I'm at a firm where I'm the oldest team member in my young 40s. So what's great is me and Mark have built up a great team that can sit down one-on-one with these younger investors who can relate to them, right? To their goals that they're dealing with. And so I think that's a good thing, is that ultimately we can relate on a one-to-one basis in multiple levels.
And what do you think do they want anything different in their investments than maybe some of the, I don't know, the baby boomers or just some of the older investors?
Great question, Paul. They're more risk averse, believe it or not.
Oh, okay.
So what we find out is that investors in their 20s and 30s, they're not having experience yet in investing into equities. And so what we see at a lot of times is we are spending a lot of time educating them, Paul, up front on risk, reward, volatility, goals and objectives. Because ultimately, with the time horizon they have, they're going to be very much benefited by having that equity exposure. But then we have to get them past those day-to-day and month-to-month headlines that might derail that bigger plan, if you think of it.
And it's interesting. I mean, the younger investors now, fixed income is actually an option. There's a generation of people who have had nothing but zero interest rates that have had to go out and take more and more risk, whether it's equities or alternatives. Now, fixed income can really be a percentage of your portfolio.
Absolutely. I mean, I think, going back to Matt's point about at some point, you got to start thinking about locking in some longer term rates. While we have these great short-term rates, you got to go out and enjoy that. It's time to harvest. But at a certain point, I think over the next, say, 6 to 12 months, looking at longer durations is probably going to make a lot of sense.
What are you hoping to gain from this week here at this conference?
First and foremost, easy question, networking with my peers. Yep. That's where I get a lot of good information, best practices. We're not here to reinvent the wheel. And so I have a good group of like-minded individuals that we network with. We have a great study group of about 10 other advisors that me and my business partner, Mark, we meet with, and we share and get a lot of good ideas on how to run our practices.
All right, Matthew, thank you so much for joining us. Matthew Jessup, he's the CEO and Managing Partner with Jessup Wealth Management, joining us here from the Commonwealth Financial Network's 2023 national conference, getting a sense of how to build a business in the financial services business, and dealing with all types of customers, in this case, clients, investors, building the business. Looking at the markets here, a little bit mixed here. We got the S&P 500 up about 0.2%, so giving back some of those earlier gains. The Nasdaq's actually down about 0.1%. Looking at the yields continue to pull in here. The 10-year Treasury's off about 6 basis points, 4.63%. Looking at the commodities front, oil making a move higher here, up about 3.3%, $85.66 for WTI crude. Well, more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. A lineup of major banks opened their books today. JP Morgan, Wells Fargo, Citigroup all delivered better than expected third quarter results as banks benefit from higher interest rates. Bloomberg's Shanali Bosick explains.
It's because you're seeing them really lend, and the consumer is taking on more loans, especially excluding credit card loans. You're seeing consumer loans start to rise on average at JP Morgan. We were talking about this. How much demand really is there for loans in this interest rate environment? How much propensity is there from the banks to lend to the U.S. consumer, given those concerns about the economy?
JP Morgan right now up nearly 3%. Wells Fargo beat expectations for net interest income and raised its full-year guidance again. CEO Charlie Scharf says that while the economy is resilient, Wells Fargo is seeing the impact of a slowing economy with loan balances declining. Shares right now up about 2.5%. And Citigroup reported FICC sales and trading revenue for the third quarter that beat expectations. CEO Jane Fraser said U.S. personal banking had double-digit revenue growth. But there was a deceleration in spending, which shows an increasingly cautious consumer. Shares of Citigroup right now, they are up about 2%. And Deutsche Bank CEO Christian Sewing spoke to Bloomberg about how geopolitical tension created by the Israel-Hamas war is impacting the economy.
I do believe that last week's events, the horrific events which we have all seen, did not really have a material impact yet on the economy. But this is exactly the dangerous part, because it only needs one or another event, and you see actually a huger or a bigger impact on the markets.
Saving says we need to stay vigilant and diligent. I'm Lisa Mateo.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's coming up to 10:22 on Wall Street. I'm Nathan Hager. We check the markets all day long here at Bloomberg. Stocks are turning a little bit mixed. We got data from the University of Michigan that shows Americans' inflation expectations over the next year are at a 5-month high. Consumers see prices jumping 3.8% over the next year, up from 3.2 in a reading just a month ago. The overall market, though, is still showing signs of life with bank earnings in focus. Big beats for JP Morgan, Wells Fargo, and Citigroup. As I said, we check the markets all day long here on Bloomberg, and right now the S&P 500 is up 0.2%, up 7 points. So giving back some of its earlier gains, 43.57 is the S&P level. The Dow's up 0.4%, or 149 points at 33,780. The Nasdaq is now down 0.2%, down 24 points, 13,549. 10-year Treasury's up 14 30 seconds now for a yield of 4.63%. The 2-year is at 5.05%. Watching NYMEX crude, it continues to jump up 3.5%, or $2.87 at $85.80 a barrel. COMEX gold still quite a bit higher, up 2.3%, or $43.70 at $19.2660 an ounce, with Haven Assets getting a bid on concerns that Israel could be preparing a ground invasion in Gaza. Right now, the euro a little bit weaker against the dollar, 1.0507. The yen is at 149.68. One of the biggest upside movers right now, Dollar General. It's up 8.6%. CEO Jeff Owens stepping down after nearly a year on the job. The stock has plunged this year with safety concerns for workers on the rise. The former CEO at Dollar General, Todd Vassos, is now going to take over for the foreseeable future. That's a Bloomberg Business Flash. Bloomberg Markets continues with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate that. We're broadcasting live from Commonwealth's 2023 National Financial Advisors Conference at the Gaylord Rockies Resort in Aurora, California. Today we're joined with our host here, Brad McMillan. He's the CIO, that's Chief Investment Officer for Commonwealth. Brad, thanks so much for joining us. Thanks for having us out here in Denver. Appreciate it. So I see a bunch of your clients walking around here, registered investment advisors. When you sit down and talk with them and mingle with them, what are some of their biggest concerns here as they try to figure out how to navigate these markets on behalf of their clients?
There's a couple of things that are really dominating the conversation right now. One is inflation. We see it coming down, but there's a real fear. Is it going to go back up? Is it going to go back to normal levels? And what are normal levels anyway? So that's one thing, and very closely tied to that is interest rates. And you just had Matt Jessup on here, talking about how rates are evolving, and we have, very good short-term rates right now, and people love that. But is that going to last? How is that going to change? So how do we navigate the significant shift in the fiscal and monetary structure? It's a real challenge.
So what are some of the big issues here? I mean, I think we had some earnings today from some of the big banks this morning, and it seems like pretty solid out there. I mean, they had some good loan growth, they had some good net interest markets. Some of their capital markets businesses are pretty strong. So at least looking just from today's companies reporting, it looks like the economy is in decent shape. Does that coincide with how you guys think about it?
It does, because we've had a lot of talk over the past year, 18 months, about how we're going to have a recession, and the recession is inevitable, and the world is coming to an end, and so forth and so on. What we've been saying consistently is we see an economy driven by the consumer, and we see the consumer getting more jobs at higher wages. When you have this kind of job growth, and we've just seen that has not softened really. No. We just saw the most recent data. When you have this kind of job growth, when we have this kind of wage growth, when we have this kind of spending ability growth, we don't see a recession. So when you look at the earnings expectations, they're kind of based on that recession thesis. And we just don't see that. And I think, as you say, today's data, the banks are doing okay because people are out there spending.
My concern is that people are outspending their income because we have seen wage growth, but it has not kept up with inflation. So prices are rising faster than people's paychecks. And you can see that everywhere when you look at the affordability of homes, of cars, of gasoline, all the things that the Fed doesn't really necessarily want to put into the core inflation category, right? But the things that we need, excess savings have been spent off. People are putting much more in terms of payments on credit cards. They're also delinquent on those credit cards at a higher rate, delinquent on auto loans, which are too much for them to afford at a higher rate. And they've got to start paying back student loans, which they haven't been doing for a couple of years. Doesn't the consumer worry you?
The consumer does worry me, and everything you've pointed out are real issues. But at the same time, when you look at the data, we have gotten worse than we've been over the past year, and that's true. But we're still better than we have been, at typical points previously in the cycle. So we still have some running room here. I mean, things are softening. We're seeing consumers maybe start to pull back a little bit, and certainly interest rates are having an effect. There's no doubt about that. But the flip side of this is a lot of people own homes with low mortgages locked in. Their spending is not going to be affected by interest rates. So there's another side to the story, but are things slowing? Absolutely. Does that mean we're going to have a recession anytime soon? I don't see it in the data.
All right, so what do you want this Federal Reserve to do? We're going to, I mean, they've been very, very clear and very aggressive in fighting inflation and raising interest rates. What do you think they're going to do over the next several meetings?
I think they've gotten to where they need to be. When you look at the inflation numbers, they're going to be trending down, if only because of housing. We know how the housing numbers are going to trend. They're going to trend down. We should see inflation in the 3.5 range by the end of the year. That being the case, when you look at the surge in 10-year yields, that's already done a significant amount of the tightening. If the Fed wants rates to be in the 5 range for the 10-year, hey, guess what? We're about there. So they have little, if anything, more to do. I expect them to keep talking hawkishly because that's what the Fed does, but I don't see a need to raise rates much further, if at all.
All right, so given that backdrop here, as you talk to some of these RIAs, I mean, are you sensing that now's the time to get a little bit more aggressive here? Maybe, maybe increase your equity allocation, maybe go out a little bit more in duration in your fixed income portfolio?
We are talking a little bit in going out in the equity and the duration of the portfolio. As Matt was talking about a minute ago, now is the time to lock in some rates. Yeah, you can get more, on a current basis, but at the same time, that's going to change. So if I'm looking to lock in a longer-term liability and I can get, 4.8, 4.9%, that's a great long-term yield to lock in. And I think you're going to start seeing that with insurance companies, for example. As far as equities go, I'm still optimistic on equities going forward. I think we have some opportunity for some earnings outperformance. We talked about that. I think valuations, most of the hit has already been taken from rising rates. So I do think there's some optimism there. I am a little bit concerned at the index level when you look at the vulnerability to the 7 major stocks. So, individual stocks, yeah, I think there's a running room for a lot of them, but we might see some volatility at the index level.
What is your outlook in terms of rate cuts? I mean, if you're optimistic on the economy and not too worried anymore about rising rates, do you see them being held at this level for much longer, or do you think that the Fed cuts rates for any particular reason next year?
It's interesting. A lot of people are calling for rate cuts, and I think that's the wrong question. I don't think we should be asking, when does the Fed cut rates? I think the question has to be, why would the Fed cut rates? They are at a level that historically is normal, and I think one of Powell's overriding objectives is to restore normality to the market. So he's there. So what would make them cut rates? If inflation were to rise again, they're going to raise rates. If inflation goes down to normal and they don't have to cut rates, why would they cut rates? The only thing that really might make them cut rates is a severe recession. And as I said, I don't see that. So I don't see any rate cuts for probably at least through next year.
All right, so I guess when you speak to some of your RIAs here, are you telling them maybe like some of the sectors you guys like I'm still bullish on tech, or I think there's still room in energy? How do you kind of frame that discussion?
Generally speaking, we're not tactical investors, but at the same time, we do recognize that, for example, small cap has outperformed over the past several years. Value has outperformed over the past several years. And we look at that and we know why that is, and we see, potential catalysts for more outperformance going forward. So we do have some overweights in those spaces. When people talk about vulnerabilities, we've already talked about the Magnificent Seven there. I think there's a chance that we might see a repricing of that as we see higher yielding investments like value stocks start to become more stable. In other words, I think we're going to see a rotation. We've seen some outperformance in large growth. I think the reverse of that is due to do some catch up.
All right, we're out here in Colorado. I feel like it's kind of energy country. What's your energy call here? I mean, with these energy stocks?
The interesting thing is when you look at energy, you're basically talking about the oil and gas prices.
Yep.
And that is going up a bit, but it hasn't really gone up that much. And I think the real tell here is what's happened in the Middle East. We haven't seen oil prices spike to any significant degree.
Yep.
And that tells me a couple of things. First of all, there's a perception out there, right or wrong, that this is not going to be a wider war.